We're also, if we stay in transport, having results from Ryanair, a material beat in Q1. The CFO is saying that things are moving in the right direction. Do traders like that at the open? And then a bit of M&A. Carrefour said to be working with Rothschild on a potential sale of its Italian operations. So we look at that as we head towards the open, Guy.
Okay, let's get you into that open. Let's figure out what is happening this Monday morning. Do not expect fireworks. Do not expect lightning to strike, because you are expecting a market that is expected to be unmoved. And that is exactly what we are getting. FTSE 100 barely budging, in and out of negative and positive territory. I suspect you're going to see similar stories with other markets around Europe as well this morning. Stock 600, we'll wait to get a little bit more clarity through on what is happening there. But there's the IBEX, barely budging as well. CAC's not expected to do much this morning. DAX could be a little bit more interesting. I think there's a few stock stories out there that could be worth watching. The auto sector certainly will be in focus. Remember, we've got Stellantis, which has just posted the preliminary read this morning. You got Volkswagen later this week, back end of this week. We're going to be seeing numbers out from the German giants, and we'll look forward to those numbers a little bit later. But look at this. What does it take to move these markets? What is it going to take this week? The earnings story is going to be one that you're really going to want to pay attention to as well. But we're counting down. The drumbeat on trade is getting more and more audible. And you do wonder why by the end of this week, whether or not we're going to be focusing on that narrative much, much more. But first thing Monday morning, Lizzie, there is nothing to see here. Single stocks, maybe the sector story a little bit more interesting.
Well, let's look under the hood, she says, as she turns to Stellantis. Down more than 2% on that news that it's recorded a loss in the first half, after the expectation that there would be a profit. So those shares currently struggling. We're waiting for some of the other individual names to open, but Daimler Truck is one of them, up 0.4%. The FT having reported that it's mulling a China production exit because of a crazy down cycle, in their words, that they've been facing. So those shares are actually recovering nicely off the back of that change of direction for them. We wait for Carrefour to open, we wait for Ryanair, but if we look sectorally across Europe, you've got just over half in positive territory. Basic resources leading the gains this morning. Autos and parts at the bottom because of, as I say, this weight from Stellantis. That sector down 0.6%. But some of the other winners this morning: travel and leisure, real estate, media. But none of these moves particularly big in either direction, guys.
So the material stocks are up. There's this Tibet dam story coming out of China that is moving forward. Apparently, it's moved the iron ore trade, which actually maybe is lifting what is happening with some of the mining stocks. So maybe there's something of a narrative to watch out there. The car sector is not responding a great deal to this news. You would have thought the scale of the miss coming out of Stellantis, you may have thought you would get a bigger reaction, but that's not what we're getting this morning.
Yeah, but when you say, it's more down to the restructuring expenses, perhaps an individual story rather than the tariff story. Let us not overstate the impact of the tariffs on the business and whether it'll be a continuing theme across the sector. But we could get some more analysis now with Nanette Heschler-Feiderb, who is, of course, EMEA CIO over at Lombard Odier. Really good to have you back, Nanette, on the opening trade. You guys been talking... Oh, well,
we'll assume that's a bad thing.
It is.
We'll come back
to you, Nanette, in just a moment. Guy, you were just talking about how we're waiting for something to happen. Is this a summer lull that we're seeing in these markets? When you look at the US, they're kind of bouncing from record to record, but they're not lifting significantly higher each time. Is it because they're waiting for trade certainty? You've got the prospect of rate cuts in the pipeline, but you've still got this continued threat to Powell. Surely that is going to continue for the rest of his term.
If you'd have come into this market and looked at all the risks that exist, and said, are we going to get a market reaction to this? In isolation, you'd be saying, yeah, these are big stories.
Yeah.
But
they can't impress. Nothing
moves the market right now. Nothing seems to provide a reason to generate a downdraft, a significant updraft. There's nothing kind of here that is exciting the market enough to get it moving. And I've just had a 2-week break, and I come back and I'm looking at these markets thinking, how on earth are some of these stories not having a bigger effect than we're seeing right now? Why is volatility being crushed? Why are equity markets doing what they're doing right now? Why is the bond market doing what it's doing right now? I'm struggling to understand why the market is so unmoved. So is it the right reaction? Is actually the data telling us that that's what you should be doing right now? Or are these risks, are we so kind of immune to them? We're punch drunk in terms of kind of where we sit, in terms of kind of how big a hit it would take to actually move things.
Well, let's ask a true expert, Nanette Eschler-Fideb, EMEA CIO at Lombard Odier. Let's go back to you. Nanette, can you hear me?
Yes, I can. Good morning to you.
Very good. Well, Guy wants to know what's going to lift the lid on these markets. You say that the S&P is treading water at the moment. Is a removal of the tariff uncertainty the answer to get a bit of excitement here, to lift these stocks a little higher?
Well, it could be both ways, really, because the 1st of August could very well see also tariffs come into effect. Right now, the market is behaving a little bit complacent with complacency, just imagining that the 1st of August would perhaps lead to the next tariff pose and so forth. I think the market at the moment is a bit oblivious to the potential that we may be waking up and seeing some of these tariffs come into effect. So I think there's both ways possibility, either a clearance with indeed some deals that have come into effect before the 1st of August under this thread, or the reverse.
Yeah, so let's look at it the other way. Let's say that August the 1st is a cliff edge for stocks. We're looking at the S&P E-minis at 6,349 right now. How fast could that unravel? How fast could that drop to 6,200, 6,000 even?
I mean, look, at these moments when also valuations seem to be high, and we are in the midst of really at the start of the earnings season, and the first batch of earnings has not been bad at all. So it could very well be that we get easily to a 5% sell-off here if there is really major negative surprise. I think the safest assumption is to view the volatility currently, the VIX at 16, as really low, and that would probably then be lifted higher relatively fast. We saw that whenever there were major surprises.
But we're not getting it. And Nanette, good morning. And the list of things out there that could upset this market is long. Yet the right trade every time seems to be to bet on risk. I'm just wondering whether or not how big the shock needs to be to change the market sentiment. The sentiment continues to be maybe more with retail and less with institutional, but the trades continues to be buy dips. Any dip that's out there, you should buy it. Is there anything that changes that in the near term?
I don't. For as long as, Guy, there is no real material probability of recession that would put us on a completely different path, I think you're right. The market is going to be biased towards using the opportunities of setbacks that can be transitory, that can be given really by anything. I mean, when valuations are really lofty, such as they are in certain sectors in the US, it doesn't take much to get a sentiment change here. But what we are going to see is a bias to buy the dip. And also historically, it's been the case that when the market is selling off by 10%, for example, you could blindly come in and benefit from it by taking, again, an entry into the market. So I think that this bias will remain for as long as there is no recession probability that is material for 2025, and that is also our base assumption.
Is this the last set of earnings that are going to be okay, that aren't going to be affected by the tariff narrative? I'm seeing a few hints here and there, and I'm seeing some comments coming through from some companies talking about tariffs, but it doesn't seem to be material yet. Is this the last time that I can expect that to be true?
I think starting the third quarter, Guy, we are going to see both an impact on earnings that is gradually going to show, but also an impact on the real economy. So far, you could argue that both on the results of companies as well as on the data of the U.S. economy and the global economy by and large, we have not seen so much effect of the tariff threat. But that is also very well explainable. One, there has been a tariff pause, so actually none of these really unraveling tariffs have come into effect. And then secondly, as a precaution, a lot of companies have built their inventories ahead of any tariff coming into effect. So once the first ones are likely to come into effect 1st of August, which is a very reasonable assumption to have, then we are also likely to see in the 2 quarters that follow first effects on both results of companies as well as the real economy.
But Nanette, you see 3 Fed rate cuts this year. If you don't see those effects showing up in earnings and the eco data until the 3rd quarter, is it really possible that we will get those rate cuts so soon? By the September meeting, for example, surely the Fed won't be able to settle this debate that's dividing the FOMC right now between whether inflation and the impact of tariffs is going to be transitory or persistent.
I think so. We are really quite comfortable with our assumption that there will be 2 cuts, certainly in 2025, most likely September and then later in the year. The reason is that, first of all, we should be seeing the negative impact on not so much of tariffs, but of the uncertainty about it on capex plans and then on the U.S. economy. We are only expecting half as much as what the U.S. economy is growing at potential. So our forecast for this year is about 1.2% growth in real terms in the U.S. That should give the Fed some room to cut interest rates, especially if those tariffs will act as they typically do when you have a VAT increase, a value-add tax increase. This is something that most economies are much more familiar with. And what it does is that it transitorily pushes up the price of certain goods that are affected. But then there are other price categories that are coming down because of the slower growth. Typically, this is the case for services inflation. And at the end of all these base effects moving out, long-term inflation expectations are remaining unchanged. So the Fed should be in a very good position to cut interest rates.
Finally, just a quick question. Energy prices. I'm really curious. This is one of the things that I've been reading about recently. What are the chances of a significant downdraft in energy prices? And how does that feed into the broader narrative that we're talking about here in terms of the inflation picture coming lower?
We have been, in fact, expecting that those energy prices would be lower than what they are now. And the reason that we've seen prices move up again from that path on which we were engaged really in the first half has been the trouble, the geopolitical trouble in the Middle East that has, in particular, an effect on trade of energy goods as well, or at least threat around it. And therefore, energy prices got, in our view, temporarily moved up again and away from that path lower. But for us, the probability is very good that we will see lower energy prices, number one, on higher supply of energy goods, in particular of oil, and number two, a slower economy.
It's interesting. It's going to be fascinating to see how that ultimately feeds into particularly the European economy. Nanette, thank you very much indeed. Nanette Heschler, FADER. EMEA CIO at Lombard Odier. Quick look at the call 6 to figure out what is happening there, and then we'll move on to the main event, which is the airline sector. As you can see, a fairly mixed picture this morning. No real standout stories that are worth focusing on there. There is a story in the auto sector this morning, and there's definitely a story in the airline sector. Let's find out what is going on. Chloe Medley, standing by.
Good morning, Guy. Let's start with airlines this morning. So we got really good numbers from Ryanair. Its profit doubled in the fiscal first quarter. It really benefited from a recovery in fares, from strong travel demand, and also because there's an easing of the delays that were associated with aircraft delivery. So that's really pushing up the stock 5% this morning, and also driving up EasyJet and Wizz Air, which are the other names in that kind of low-cost budget airline space. Moving on to a little bit of a less positive story in the auto sector this morning. So Stellantis recorded a 2.3 billion euro loss, and that was compared to expectations of a profit. A lot of that has to do with tariffs, and it's really dragging down the stock, but perhaps not as much as we thought it would this morning, down about 2%. It's a lot of these issues are company specific rather than a sector story. So it is dragging down a little bit of these other names in the car sector, but not that much. We've got Volkswagen and BMW down a little bit this morning, but Renault is quite resilient. Next up, we have got the mining sector. So iron ore is surging higher, and that is driving the stock in Rio Tinto and Glencore this morning, up about 2.3 and 2.8%. And then finally, we have got something in the real estate sector. So Covivio is in France. It's a real estate company, and it raised its profit forecast this morning. It's benefiting from a strong residential market in Germany. It also said that there was a stabilizing environment in the office sector, which is interesting, knowing the weakness that there has been recently in that market. So this forecast raise is pushing up the stock 2.4% this morning.
All right, Chloe, we thank you, Chloe Mallet, with our movers at the open. And we're going to dive into the Ryanair story even more next. Europe's biggest budget airline reporting a doubling of net income in the first quarter. We'll work out what's driving that very strong booking for the holiday months next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center. We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're seeing no softness in people who want to travel. We have limited growth this year. We're only growing by 3%. It's 206 million passengers. But demand is exceptionally high, and we've no qualms about hitting that target this year.
That's Ryanair's CFO, Neil Sorahan, speaking to us a little bit earlier. Europe's biggest low-cost carrier reporting a double of net income for the first quarter. It's getting the planes. It's getting more planes than it wants out of Boeing. Things are moving in the right direction. You can see what the stock reaction is this morning. Let's get Benedict Camel's take on this. He, of course, heads up our aerospace, aviation, defence, all of it coverage, and talk about how this is having an impact this morning. Benny, let's talk about the stock move this morning. Big market reaction to the Ryanair numbers. It all looks pretty good. It does seem as if the airline is executing pretty well right now in a market that seems fairly favourable, with maybe people not taking the long haul trips that they once did.
Yeah, you're absolutely right. I mean, generally speaking, when the market is a little tougher, when demand is tougher, that's where really the low-cost carriers come to the fore. People are taking shorter trips, both in terms of sort of time spent away and in terms of duration. Ryanair has a lot of these routes. The cost control is really doing well at Ryanair. We heard the CFO speak about it just now on TV a little while. So that's all really helping the company. And this is only the first quarter, so a lot of analyst reports that I've read this morning point to a very favorable outlook, saying there's real upside in terms of what they can do this year. So also an interesting contrast to some degree with EasyJet, who reported last week, and their quarter was, shall we say, sabotaged somewhat by the ATC strikes that we've seen across Europe, in particular France. Ryanair dodging that bullet a little better than it feels than EasyJet, so that's really helping the stock, up almost 10% today at an all-time high now.
And Benny, we had the CFO on Bloomberg TV earlier saying that any tariffs will be on Boeing's account, not ours. Just talk to me about how that tug-of-war works for the non-airline expert in the room. Is it as easy as saying we're not paying, they can?
Well, that's sort of the fight that we're in right now. And it feels as we move towards this August 1st deadline, nobody quite knows how it's going to play out. This is an industry that has lived in a tariff-free world for the better part of sort of 45, 48 years. And they now have to come to terms with who pays what, if anything. We've heard Airbus CEO Guillaume Faury say that we're not going to pay if we ship our planes to the US. We've heard Delta Airlines is a big customer for Airbus say, well, we're not going to pay. So really, you've got this bit of a stalemate. And Ryanair now saying the same thing, saying, well, we have fixed contracts with Boeing on our planes, on the cost, so we don't want to cough up that money. So how this will play out will be very interesting. These are mobile products, the aircraft, so they might find a way to sort of take them somewhere else first and then import them. But broadly speaking, this is uncharted territory for the industry, and we're hurtling towards that August 1st deadline. So the general view is everyone's saying we hope that sort of common sense will prevail, but again, you know, time's ticking.
Benny, just give me your take on the demand picture, though, that Ryanair is seeing at the moment, and how strong it is. There was this expectation maybe that we would start to see some of the demand fading. Where's it coming from? Why does it remain as strong as it has been, and why is the outlook so positive?
Well, they're doing very well in some, should we say, fringe markets. So they're flying into Scandinavia more, where the costs are low. They're basically able to move their kit around fairly nimbly, and they're going to places, as I said, Sweden is a big market, Eastern Europe is a big market. They're also benefiting from some of the weakness that others are experiencing. We know that Wizz Air has huge problems with their fleet, so that's helping them. Germany is not much of a bright spot for Ryanair, so that's probably one that is hurting them a bit, and it's been very difficult for them for a long long time, but they can move into the places like Iberia, they can move into places like Spain, like Greece, Scandinavia. Those are their strong markets. And so it's a mix of people going to sort of lower cost airlines because they might reconsider the big expenses, and that some of the other carriers, in particular Wizz Air, is having a tough time.
All right, Benny, we thank you. Bloomberg's managing editor for global aerospace and defence coverage, Benedict Camel. Now, I want to stay in the transport space, but a more negative story for Stellantis. Shares moving lower after the automaker recorded a €2.3 billion net loss in the first half as restructuring expenses, waning sales, and the impacts of US tariffs hit. So we can get more now with Bloomberg's Albertina Torsoli. Albertina, we talk about the tariff hit here. Is this actually a theme that we're going to see across automakers in Europe, or is this a more individual story unique to Stellantis?
I certainly think it's a two-way story here. The U.S. tariffs hit is quite something for the company. We still don't have full-year guidance for this company. It was given at the beginning of the year, then it was suspended because of tariff uncertainty. And today, as of today, we don't have guidance. And so what prompted Stellantis this morning, the maker of Fiat cars, but importantly of Jeep SUVs in the U.S., to issue this statement is this lack of guidance and the discrepancy between analyst forecasts and the reality that they are facing today. So they do cite a 300 million euro hit, about a 300 million hit from tariffs. That includes lost production as part of their response program. Stellantis had shut down some of the plants in the US while it had waited more guidance, more news on the tariffs. But there certainly are other items at play here. There are impairment figures. There is a closure of programs, and they will be giving more details on all that when they present full detailed first half results on the 29th of July. But some aspects are already emerging. For example, Stellantis decided quite recently, to drop investments in hydrogen. That has an impact today, and also is shifting a lot of the focus on hybrids. Former CEO Carlos Tavares was pushing all out on electric vehicles. The demand for electric vehicles is not there today as was expected, not in the US and not in Europe even. And so I think that there's a lot of readjusting of priorities here, and this is part of what we're seeing today beyond the general sluggish demand for automobile that we see everywhere in the US and Europe.
It's interesting, Albertina, we do have a new CEO in, as you say. Maybe part of what we're seeing this morning is a reaction, his first reaction, maybe to what he's found under the hood, as Lizzie would call it, at the business. So it'll be interesting to see whether or not actually that's why we're seeing such a mild market reaction. Albertina, thank you very much indeed. Albertina Torsoli. Coming up, we're going to carry on our conversation about what is happening in Germany. German companies planning to invest 700 billion euros in the country's economy. We're going to have Allianz's CIO on next. Ludovic's going to be joining us in a moment. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real. How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade, and we're 30 minutes into today's session. You're looking at the Stock 600, pretty flat at the moment. A bit of outperformance for the FTSE 100. That is the best performer across the continent, and the best performing sector is basic resources. So the two, of course, linked, the miners dominating the FTSE. You've got iron ore and steel prices climbing this morning on the back of China's plan for a mega dam in Tibet. That's bolstering the outlook for demand and boosting the likes of Glencore and Anglo-American here in London. But the trade story is going on in the background as we approach that August 1st tariff deadline, and the European Union is looking to send some of its envoys to meet to formulate a plan for measures to respond to a possible no-deal scenario with the US President Donald Trump. Now, the US is now seen to want a near universal tariff on EU goods, higher than 10%, but how is Brussels going to react? For more, we're joined by Bloomberg's trade czar, Brendan Murray. And Brendan, when you look at all of this, I wonder how likely retaliation from the EU is, what form that would take, and who it is out of the member state that's really pushing for the hardest kind of form of retaliation.
So these negotiations seem to be going along pretty well a couple of weeks ago, but something happened and they just sort of got bogged down on some of the key issues. We heard Commerce Secretary Lutnick over the weekend say that he thought he was confident that they could get a deal, but he also said, I think it's because the member states are going to realize that it's going to become more painful for them if they don't. So it wasn't like he was offering, because we're going to offer some concessions and we'll all see eye to eye in the middle. So the Europeans have a real big choice to make. Do they escalate? Do they meet Trump's tariffs with barriers of their own? Or do they sort of accept, an unfair negotiation and sort of take the economic pain? They have been saying all along they want that universal tariff rate to stay 10%. The U.S. is still at 30%, so can they get somewhere to, say, 20% without a lot of other member states saying that's too much for our auto industry or other industries that will be hit hard?
Back in April, the market freaked out. Everybody got really upset about what potentially was going to happen on the tariff front. We are now in the almost exact opposite scenario, where the market is unmoved by any of these headlines. Kind of, what is your assessment of the likelihood of something significant happening here? Or is the market right to park this one and kind of continue with this lack of sensitivity to these headlines that drop on an almost kind of minute-by-minute basis?
I think we've got a good enough track record now to say that the Trump administration strategy is maximum pressure, maximum leverage, apply that until the very end. We have 2 weeks until this August 1st deadline, And there seems to be, as you suggest, this complacency that eventually they'll see eye to eye and they're not going to go full transatlantic trade war. This is, after all, the world's biggest trade and investment relationship, and there's $1.5 trillion worth of economic activity between the two. Blowing that up would be detrimental to both sides. So I think there's a sense that they will get to some agreement. Someone's going to have to take the short end of that, and the Europeans are trying to figure out right now is what is that pain threshold that we'll be able to accept that the U.S. is going to apply.
We'll wait and we'll watch. The next few days could be quite interesting. Brendan, thank you very much indeed. Brendan Murray updating us. It's going to be an interesting week this week. I think next week, really interesting. We're obviously watching all of this unfold as we think about how the German economy is kind of moving forward. More than 60 of Germany's leading companies unveiled in an investment drive worth at least 100 billion euros this morning. New projects we're talking about here. The whole idea is it's going to help lift Europe's biggest economy. Now, Bloomberg's Ollie Crook a little earlier spoke exclusively for two of the leaders of this group, Siemens and Deutsche Bank, the CEOs of both of those two businesses, and their aspirations and where they're going in terms of what they expect future growth to look like. They also talked about how the tariff story is going to impact the outlook as well.
Let's put it that way. We will end up in higher tariffs vis-a-vis the United States. Yeah. What we don't really want, actually we wanted to have lower ones because we believe in free trade. This stimulates economies and growth. So that would drive inflation to some point. However, there's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts, how the tariffs look like.
And we've been talking, Christian, a lot about European champions and changing the way that we think about preserving companies at the national level versus the European level. And I want to understand sort of when you look at Deutsche Bank, which is now at the end of what was a very long turnaround process, but now is feeling like it's in a strong and confident position. Is this a moment for Deutsche Bank to get into a much more sort of aggressive mode in terms of expansion mode, potentially looking at M&A across borders? What do you want Deutsche Bank's role to be in the kind of world of European champions?
Well, I do think what we see in this world is with all the geopolitical uncertainties, with all the also economic uncertainties, there is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. Mm-hmm. We have very strong US banks, very capable US banks, but in this world of geopolitical uncertainties, they want to have a capable global European player. Mm-hmm. And there are not so many European banks left with a full investment bank, with a full corporate bank, with a global network in over 60 countries. That's the role we can play. Now, this role we not only want to play because we feel ourselves as a global bank, but it's obviously much easier to do that if you are coming from a country which is economically increasing, which is economically on the right path, and which is also pulling now Europe. And therefore, I think we have a unique chance, not only as Germany and Europe, but also as Deutsche Bank, to actually be the one who is facilitating and who is contributing to our clients' growth around the world. The diversification also in banking, not only to rely on one bank, but on many banks, and that from a regional perspective has never been bigger than RAN.
And you touched about diversifying, and just another question to you. Is this Buy Europe trend, is this a lasting thing? Is this something that you're seeing from investors that you talk to, that they're wanting to make a meaningful commitment to Europe? And what does that actually look like in terms of numbers from where you're sitting?
Well, for the first time, we see, obviously, since the last 3 or 4 months, a quite significant reallocation from funds, in particular into Europe. The interest is huge. Whenever we talk with investors, they really want to understand what's going on in Germany, what's going on in Europe. By the way, already in Davos this year, 6 months ago, most of the investors said, micro, Germany is really good, and with that they mean the German corporates, the German companies. Macro, you need to do improvements.
You need to do improvements. Are we going to start seeing those with the Merz government coming through? Certainly, the mood music coming from both of those two gentlemen really quite positive. Deutsche and Siemens, two of Germany's biggest companies. But in the background, we still have this huge threat that is coming in the form of potential tariffs. Ludovic Surbrand, Chief Economist and Chief Investment Officer at Allianz, joining us to discuss. In terms of where we are, Ludovic, right now, we've got this incredibly kind of positive picture being talked about by German corporates. We just heard from Deutsche, we just heard from Siemens. yet we could be, there is the potential for significant tariffs to be imposed over the next few days, and the market is basically ignoring all of that. Where do you sit currently in terms of your expectations for how the European economy is going to develop, given the threat that it faces from this tariff war?
Well, look, it's a particular crossroads now because we have a few weeks to know what's going to happen with the 30% tariff threat. We all hope for pragmatism and something landing around 10%. But of course, this is a huge uncertainty for all the corporates that are making, hundreds of billions of turnovers in the US, right? Just Germany alone, we're talking about 163 billion last year for German corporates in terms of revenue in the US. So imagine how much of a stake there is in this trade war to be muted in the next quarters. So it's a big topic. I think this Made for Germany initiative is extremely welcome. Germany is slowly but surely going over its PTSD from 2022, when it realized that the entire model was off. Yeah, and so I think this announcement is very important, alongside the announcement of public money that is going to be a key driver of growth for infrastructure, for defense, alongside reforms. But the key missing in action person, the one part that is very important, is the 99% of German companies that are SMEs and that need to grow their investment. Just to give you a figure, between 2019 and 2024, capex, investments by corporates in Germany went down 7%. So the government is also trying to do something about this, but it is also, there is part of psychology, as Ludwig Erhard used to say, the former Chancellor of Germany, but it is about, the moms and pop shops, the households, and this is where we still see record high savings, 20% plus, right? So there is still something there to unlock for Germany and for Europe in general, because this problem is widespread around Europe, to be also growing on its own without waiting for growth from outside, especially if the uncertainty continues to be there when it comes to the trade war.
But which of these two factors will end up being more dominant, though? This idea that Germany does need to invest, this idea that there is the money there to unlock, and that can be deployed and can deliver significant results. But at the same time, the overarching theme is that we are facing a much tougher trade narrative with the United States, a key market for many of these small and mid-sized companies. Which of those two things do you think will end up being dominant? Is it possible to have a positive story when a trade war is looking more and more likely?
The answer is yes, because the domestic market in Europe is pretty huge. And this is, the Draghi report in action. We need to deepen our single market. We need to find ways for us to be independent on a series of topics, including energy, including tech, including the euro. So I think the trade war is a massive headwind. Let me start with that. I mean, a few percentage points of additional tariffs on Europe to the US is costing, a few, not 0.1, not 0.3, not 0.5 points of growth for Europe. So it's huge, right? And not to mention the ECB. The ECB, we expect the ECB to pause this year, but if the tariff from the US is, landing around 15%, the ECB will have to drop another 50 basis points of key rate, just to make sure that the financing of the economy is not endangered and that we don't go into recession, right? So there is really a Gordian node here, right near what here about the tariff, but there is also a lot of initiative that could be boosted here. Christian Sewing, the CEO of Deutsche, was talking about the reallocation into Europe. I talked to tons of CIOs from the US that tell me, money is following defense. Europe, yes, it's complicated, but it looks like you guys are after something when it comes to making your savings productive. So there is a correction of the negative bias that was, tainting Europe for quite some time. Also because we look more stable, we look more rules-driven. We also look a little bit more forward-looking in terms of where we want to spend the next 5 to 10 years of our massive efforts, be it with, German public money being unleashed, but also the type of initiative that are going on right now to make sure we are creating a form of different ecosystem, right? It doesn't save us from the thunder of what the trade war is going to bring, and beyond the trade war, also the frictions between the US and Europe on a series of topics, including on energy, including on defense, and including on finance. But it is a moment where it's quite interesting. I think the European Union, the European Commission are called for action by every business leader in Europe, which is also very interesting to see as a reverse call for action. We are really wanting them to make a bold move so that there is a form of trickle down of this whole Europe narrative, and it's not just a stint. Yeah.
Ludo, I was interested, you said that the ECB is going to pause rates this year. I take it that you don't see any more cuts for the rest of 2025. And when we think about the ECB, of course, it's not just trade as a channel through which Trump can affect the rates. It's also his threats to Chair Powell. We had the ECB's Joachim Nagel saying that the effects of ousting Powell would be felt outside the US. I wonder what you think that would look like for European markets and if you agree with him.
Yeah, so first, the ECB will pause this week, but we still have two rate cuts that are planned for September and October, just to get that right. So, but the real question is indeed what's happening on the euro dollar. It's been a massive roller coaster since the beginning of the year. And so there is now this moment, we're a bit in a difficult situation now. We don't want the euro to be too strong, especially for our competitive advantage on trade, right? This being said, there is something here about building an alternative to the dollar as the dollar erodes slightly, that the euro becomes a currency where, emerging markets want to issue in, or a currency where a lot of the financing of the defense efforts we want to do have to be in this currency, just like, the energy sector needs to be in this currency to lower the dependency. So I agree. Yeah, I would say whatever is happening now in the US and especially on the Fed is a massive driver of everything market related, including Europe. But there is also for us a bit of time to engineer something slightly different. When I think about the armada of stable coins that are making their way to the markets right now, Europe needs to have a form of alternative to this. When I think about payment systems, we need to have an alternative for this. And I think President Lagarde called for action on this. I think a lot of us are thinking, okay, how is it a way for us to get some of the crumbs that the dollar is leaving behind and making it a strength at a moment where Europe is trying to turn around a bit the psyche of investors, of financial markets, and trying to make it, a homegrown market that is decent.
You talk about a call for action. Is that call for action going to be delivered outside of Germany? Germany seems like its own situation at the moment, and the rest of Europe doesn't. And I'm just wondering if the two fit together. The rest of Europe doesn't have the potential that Germany has right now. Doesn't have a debt break to release, the potential to spend all this money. Are we confusing Germany and Europe sometimes?
Well, there is, first, to be fair, it's true that when it looks like the heavy lifting for defense, everybody's looking at Germany because they are the only one with fiscal space, right? So I often tell my French friends, if you expect that the German money going to defense is going to your big companies in France, you are wrong about this. We are one, but still, the German public has been saving for that moment. And so most of the externalities need to be for Germany. This being said, I think we see so many good news from Italy and Spain, who have basically been back on a primary surplus very fast, also because of the crisis they went through in 2012, 2014, but also because they've done the right reforms on a series of sectors and incentivizing a lot of private investment growth in the countries. In my country, France, we have a lot of big companies in the sectors that are in that's the moment of the sectors of defense. That's the moment of AI. That's the moment of energy transition. And it happens that a lot of these big companies and middle-sized companies are in France right now. So I would say the only way that this German moment becomes a European moment is if we look for complementarities and efficient specializations and comparative advantages, which is something Europe has not been historically very good at. We've all been very, standardizing a bit the expectations from countries. It looks this time around that some of the countries have something to offer. Not all of them have money to offer, that I would agree with you, but some of in my country, France especially, it may not have a lot of money to offer, right, public money, but there is still, everywhere I look, there is still very high savings rate and there is still very low capex growth rate by companies. So that's where the psychological element is very important, because they both, households and companies, have some to unleash right now if we want to finance the next 5 to 10 years of Europe, including with a security tilt.
Well, yeah, we've got Merz and Macron meeting in Berlin this week. Both of them have been in London over the past couple of weeks. Maybe a sign of progress. But Ludovic Subran, Chief Economist and Chief Investment Officer over at Allianz, always good to have you and your beautiful art on the opening trade. We thank you. Coming up on the programme, we're bracing for a slew of earnings this week from sectors including banking, travel and telecoms. We'll get your preview next. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Minutes into today's session. Welcome back to the opening trade, and it's pretty much the Stock 600 treading water this morning. The worst performing sector actually are the banks, and we already heard from the CEO of Deutsche Bank speaking to Bloomberg's Ollie Crook earlier in the programme. Speaking of which, we've got a slew of earnings in Europe this week. Banks, the big sector to watch. Lenders impacted, of course, by interest rate cuts and geopolitical tensions. So let's get a preview now with Bloomberg reporter Chloe Mellet. Chloe, let's talk about Deutsche. What are we expecting out of their results?
Yeah, so for Deutsche, we got a little bit of a preview, a taste of what's to come when the CEO recently mentioned that there had been a little bit of a bumpy second quarter in the trading business, and he kind of readjusted expectations down for the revenue there, and also mentioned a weaker than expected performance in the advisory business. So we know from that the earnings might disappoint a little bit. A bright spot might be the corporate banks. So obviously companies want to restructure their supply chains. They are looking to invest in defense industry as well, especially in Germany. So that might be a bit of a bright spot. We're also looking to hear about the progress on cost cuts there, the performance in the private bank, and there might be a buyback. Analysts are also thinking about that.
Is it the only bank reporting this week? I thought we got a few others.
We have a few others. So we have BNP, we also have NatWest and Lloyds. The key thing to look out for this earnings season, in particular as all those banks come through, is that the second quarter is likely to be much less resilient than the first quarter was. So things are starting to catch up with Bank. Lizzie, you mentioned the interest rate cuts. That's starting to feed through into lower net interest income. We saw that with the Nordic banks earlier this earnings season, and obviously the tariffs and the uncertainty, that's feeding through into cost of risk and into maybe higher loan loss provisions as well. The UK banks might perform a little bit better. They have structural hedges, and that's kind of alleviating the impact of rate cuts and kind of shielding the revenue there. So that might be a little bit better from Lloyds and NatWest on Thursday and Friday.
Look forward to hearing all about it. Chloe, thank you very much indeed. Chloe Mellet joining us as we work our way towards some of those bank reports. What else are we going to be looking out for this week? The German Investment Alliance Summit is taking place today. We've already been hearing from the CEOs of Siemens and of Deutsche. We've got US home sales, I think, tomorrow. Merz and Macron are meeting in Berlin, as Lizzie was saying. We've also seen meetings with the UK leadership recently. How does it all fit together? It feels like a kind of three-way triangle beginning to be formed between Paris, London and Berlin. Thursday, global PMIs. Got EU and Chinese leaders meeting in Beijing as well. That's going to be fascinating. But maybe the main event on Thursday is going to be the ECB rate decision, though it is unlikely to deliver much of an outcome. I think the commentary going with it will be fascinating. Plus, also, we have UK retail sales out, which is usually something of a weather forecast or a retrospective weather forecast. Anyway, let's see what Valerie is going to have her eye on it this week, joining us around the table. What are you going to be watching?
Well, I think European bank earnings are going to be interesting, as Chloe was talking about, but the other big highlight, at least for monetary policy, is going to be the ECB decision. And what's really changed between their June decision and now is you've had this renewed threat of tariffs, this 30% number talked about, threatened by President Donald Trump. And already at the June decision, Christine Lagarde characterized the risks to economic growth as tilted to the downsides. The market will be watching keenly on if she perhaps changes that language. Does she perhaps sound just an incrementally bit more bearish? Because if she does, I think the market will start to price in that the chance of a September rate cut. They do have a 7-week pause in between this decision on Thursday and September. So there's a lot of time in between those 2 points. Maybe we'll get more clarity on the trade policy, and with that, some more clarity on the rate trajectory for the ECB from here.
I also just want to talk about Japan, Val, because Guy told me don't even try and analyse the yen moves right now. Of course, you've got Japanese markets closed, the bond and stock market closed. But what do you make of what we're seeing of the limited reaction to that election result?
Well, look, the yen is stronger, so it's having a bit of relief. But also, look how European government bonds are performing this morning. I think they're anticipating we also see a relief rally when it comes to JGBs tomorrow when they reopen. So it does seem like a market-favorable election result. I think maybe the market was bracing for something a lot worse, or perhaps they had just priced in a lot worse in the weeks going into this decision. We know that, for instance, the yen had weakened around 3%, and some JGB yields had hit 2-decade highs.
But do you think that really is all about Japan? Or is it actually that the market's just looking through Japan and now looking onto the trade story and the ECB story?
Well, look, I think that Japan, it definitely has set the tone, at least for how fixed income has traded recently. So this could possibly just set us up for a decent, rally, a summer rally headed into July if those fiscal worries in Japan are put to bed for now, for whatever reason, whether that's warranted by this result from the election or not. But it seems to be the read-through so far this morning.
Okay, well, we'll keep an eye tomorrow when we get Japanese markets back on after Marine Day. But Bloomberg's Valerie Teitel, we thank you for that setup to what's on the docket for the week. Of course, we've got a busy week for earnings here in Europe and that ECB meeting out of Frankfurt. A hold expected from Madame Lagarde. But as things stand, we're looking at the Stock 600 treading water, as I say, weaker 1/10%, slight outperformance from the FTSE 100, but things yet to pick up speed. Guy, you'll be with the next hour.
Sure. Yeah, we're going to carry on the conversation, figure out exactly what is happening in the bond market, try and analyse what is going on in Japan, and prepare ourselves for what is going to happen on the trade front next. That seems to be the narrative we're building to this week and into next. We'll leave you with the grey skies of London, a few blue moments peeking through. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The Japanese Prime Minister vowed to stay on despite a historic election setback that saw his ruling coalition lose its majority in the upper house. EU officials are set to meet in the coming days to plot a possible no-deal scenario with the United States. This as Washington hardens its stance on tariffs, plus Ryanair rockets but Stellantis stalls. We're going to bring you a roundup of the key European earnings that we are watching. Let's start, though, with the markets, the bigger picture, the macro, top down. US futures currently a little bit positive. European equities are going nowhere in a hurry this morning. It's a big week. There's plenty on the agenda, plenty on the docket. Actually, a bigger move, you could argue, this morning in the bond market. Certainly that's what we're seeing here in Europe, and it's being reflected to a certain extent over in the United States. We are not getting a reaction to the Japanese story and JGBs. They're shut, but maybe what we're building up to and setting ourselves up for is that reaction tomorrow. Euro dollar trading 116.44. Dollar yen, a little bit of a bid coming into the yen. We saw a fade into the election. We're seeing maybe a little bit of a bid coming out of it. Is that a relief rally, or is it actually people seeking havens? And the yen is certainly one of those. So we'll talk about that in just a moment. Before we do that, though, let's focus in on what is happening more broadly here in Europe. As you can see, a fairly mixed picture across the continent this morning. Italy a little softer, Stellantis front and centre there. A little bit of a surprise warning coming through this morning from that company. Maybe it's a restructuring narrative with a new CEO there, but it's hitting the Italian market. FTSE's going nowhere in a hurry. CAC, to be honest, is going nowhere in a hurry. In fact, it's a largely becalmed market this morning, waiting for a catalyst. Where does that come from? Well, that's what we're just going to discuss coming up next. Let's get things going right here on The Pulse.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
It's me, Guy Johnson, this morning. No Francine. She's out for the day. But we've got a great guest lineup and plenty of things that we need to be discussing. Let's kick things off with trade, which I think is going to be a story that's going to develop throughout this week as we head towards the 1st of August or potentially the 6th of August, a little further down the road in terms of the European response. European envoys potentially set to meet over the next few days to formulate a plan basically to put forward measures to respond to a no-deal scenario with the United States with US President Donald Trump. The US is now seen to want a near universal tariff on EU goods that could be higher than 10%. But US Commerce Secretary Howard Lutnick says he believes a deal with Europe can still happen.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Howard Lutnick. Let's talk to Bloomberg's trade czar, Brendan Murray, who joins us around the table. Brendan, the market's become very complacent about the risk coming through from trade. The EU feels like it's now it's sort of waking up to the risk that actually a no-deal scenario is now possible. The market's yet to get there. How big a risk is there here?
Well, I think it's a growing risk. I don't know how big it is yet, but it's heading in the direction of riskier in terms of the economic fallout that this could create. The important thing that Howard Lutnick said right there was it's going to be great for America. The flip side of that is it's not going to be great for the European Union. So officials in Brussels are going to get together and try to figure out how much pain can we actually take. What is the threshold of that reciprocal tariff? 10% would be, they would take 10%, they could absorb that, but 30%, the way it's proposed right now, is going to cut off trade significantly between the two trading partners. So the real question now is, we've seen a lot of deals come along, talks of deals, frameworks, and various sorts of arrangements toward the deals that Donald Trump wants to get together, but we haven't seen any real retaliation, and the Europeans are threatening what would be the first significant kind of retaliation if it gets to that point.
It's interesting. We're all focusing on what is happening across the Atlantic, but in reality as well, we need to focus on what is happening with the relationship with China too. We've got this EU-China summit coming up later on this week, and it now looks as if we're going to see a Trump-Xi summit as well on the fringes of the APEC summit. What do we know about all of this and how that side of the relationship is going to develop?
Well, the European relationship with China is also not in a great place right now. They've had a number of sort of back and forths on various issues. The meeting this week in Beijing will be an attempt to try to put that back on track and to try to show that the two sides can work together as strategic, sort of allies and competitors. But the three economies are in a difficult position right now, and they're all trying to jockey around to figure out who is really going to be, who has the leverage in all of these different negotiations.
Brendan, great stuff. Thank you very much indeed. Brendan Murray on what is happening with the trade story. We're going to be gathering momentum as we head towards the back end of this week, I suspect, and that story is going to be front and centre. The story that is front and centre this morning is what is happening out in Japan. The Prime Minister has insisted that he will stay on despite his ruling coalition losing its majority in the upper house. Remember that Prime Minister Ishiba has now lost the lower house and the upper house. Haven't seen that since, I think, the mid-50s. Anyway, this is also going to complicate matters when it comes to trade talks. Ishiba insisting that actually there will be no impact on that, but that's hard to see with this political instability. And it's unclear kind of what happens in terms of meeting the US president. Remember, we've had the US Treasury Secretary in Japan as well. So what happens next is going to be key. Let's take a listen to what he had to say on that matter.
We must protect Japan's interest in trade talks with the U.S., keeping in mind the deadline of August 1st. I have passed this message to U.S. Secretary Bessent when he recently visited. Akazawa will be visiting the U.S. from today, and I hope to show tangible results in trade talks soon.
Let's talk about the implications of all of this. Alice French joins us out of Tokyo. Alice, Ishiba is implying that he needs to continue with these trade talks. Japanese markets are closed today. Do we have a sense that maybe actually things have got more complicated? And are we going to get a greater sense of that tomorrow when markets reopen?
Morning. Yeah, like you say, I mean, things are basically just even more unclear now than they were before. We actually saw the yen strengthening slightly today, I think partly on that sort of safe haven demand amongst all of this uncertainty, and also because the yen had already weakened quite a lot last week on worries around this election. Like you say, trade is going to be a big focus here. I think, election or no election, the talks hadn't really yielded any concrete deals so far. So there's already a lot of uncertainty and worries around that. And now a lot of people I've been speaking to here today saying that it looks even less likely that Japan will be able to get a positive deal now that Ishiba has been weakened domestically. Like you say, obviously, equities trading is closed today, but tomorrow I think kind of those trade-sensitive sectors, things like big exporters, automakers, are really going to be in focus in terms of, where investors are going to be looking to put their money, and they may be the ones that lose out on this.
What is the fear here? Is it that we see more uncertainty? Is it that maybe we don't see rate hikes coming through from the BOJ in the way that we had anticipated? What is the threat that emanates from this election, from the fact that the LDP, for the first time since the 50s, no longer controls both houses?
Yeah, like you say, I mean, it's basically just this general uncertainty about where do we go from here in terms of policy, right? Fiscal policy, for example, we know that Japan has a huge government debt burden, more than 200% of GDP, and there have been worries around government spending and what Ishiba is going to be able to do about that now that he's weakened. We know that opposition parties have obviously bolstered their influence in the upper house. Several of them are asking for tax cuts to the consumption tax. How is that going to be funded? How will Ishiba be able to push forward with his plans for increasing defense spending if government spending plans are changed? And then, like you say, obviously trade. And the BOJ is looming all over this, right? We know that if there's going to be less certainty around policy, they may be more cautious with their future rate hikes. I think in general that the consensus is that the BOJ will have to push forward with those hikes at some point, but this election outcome may slow down the pace of that, and for some investors that's going to be bad news.
Alice, yep, we're going to watch tomorrow with a great deal of interest to see how this all fits together once all these markets open. Alice French joining us out of Tokyo. Anika Bedeby, portfolio manager at Julius Baer, joined me around the table this morning to think about all of this. Good morning.
Good morning.
Uncertainty, just more uncertainty. Japan is creating more uncertainty. You've got the trade story looming. We don't know what's going to happen there. It feels like a bigger threat than maybe the market is looking for at the moment. Yet, asset prices look good. Markets have rallied. The market seems very calm. Is that the right place to be right now? Is this still a glass half full kind of environment?
Yeah, good observation. So we've seen this interplay between markets and investors being worried about top-down factors, those that you mentioned, tariffs, trade, inflation.
Yep.
But on the other hand, markets have been driven by bottom-up factors. The fact that consumers still seem very healthy, the fact that business sentiment has improved and business activity is increased if you look at, what's going on with the earnings in the U.S. So what I suspect will happen is once we get some more clarity on the top-down factors, markets will continue to be driven by those bottom-up factors. And I think where we are with especially equity markets in the U.S. is we're approaching the final stages of an equity bull market that's been somewhat extended by Trump's U-turn on tariffs, the One Big Beautiful bill as well. And because we feel we're in this, the final phase, we're actually diversifying our exposure away from the U.S. into other markets, including India, Japan, and Europe.
Okay, two things to unpack there. The final phase of a bull market, what happens when that bull market comes to an end?
Well, it could be extended for quite some time.
Right.
Obviously,
the final phase could be the end of it could be a way away.
It could be a way away. And what we've been seeing is that U.S. secular outperformance has been driven by, of course, the Mag 7, the AI theme, which, could go on for some time. Now, and we see these results coming out, some of them this week. Now, what we see going forward is that we're going to start needing to see these companies monetize all of the capex spending that they've been doing. And we estimate that by 2027, if we don't see that, then we could get that derating the end of that secular bull market.
The corporate earnings story has yet to really reflect, but we're starting to see it.
Yeah.
The tariff story. Is this the last set of earnings you think that will be largely unaffected by tariffs? Do you think we start to see, when we get to the third quarter, that actually some of these numbers are looking a little bit more bleak? Are corporate earnings, the bottom-up story, really going to continue in the vein that they are at the moment? Because as you say, this earnings season so far looks pretty good.
Yeah, so far so good. So let's unpack a little bit what's been happening so far with the U.S. earnings. So far so good. We went into this earnings season with quite low expectations. EPS growth expected to be around 5%. We're looking at early beats already. The U.S. banks have called out that the consumer is healthy. They're not stressed by any sort of credit factors. Business activity is doing well, especially in investment banking. CEOs are looking through any uncertainty to get deals done. And this backs up the data on the consumer as well, with retail sales, retail with wage growth also.
Yep.
On the tariff front, we have not seen that come through yet, like you mentioned, but we're not quite out of the woods just yet. remember that the U.S. has still only signed deals with a few countries, and a lot of that tariff exposure that's come through, only 30 to 40% of that has been passed on to the end consumer. Going into the second half of the year, businesses may be less generous as margins start to bite. So we could actually see a slowdown in Q3, higher tariffs, higher inflation, and this is why the Fed, I believe, is justified in holding rates where they are for now.
You said you wanted to diversify away from the United States.
That's right.
Last 3 months, US markets have outperformed. Why do I want to diversify away from a market that is outperforming? And as you say, yeah, we're in the final phases, but that final phase could last a long time. And my experience of the end of a bull market is that it's the last phase generally where you generate quite a lot of the upside. I appreciate these markets have already generated a lot of upside, but it is normally the last phase where you see that final kind of acceleration.
That's right. So just a bit of a nuance there. We're still very much focused on U.S. companies that we deem exceptional.
Right.
And certainly those are the companies that are most closely related to the AI theme. So we want to have those. Elsewhere, where we can find similar companies, we're diversifying to Europe, India, China, because valuations are better. And even though the U.S. has done better in the last couple of months, there's still a huge dispersion in terms of performance between, let's say, Europe and the U.S. In Europe, for example, the businesses are, committing to investment. We're seeing talks about deregulation. All of this is business conducive. We think that all of the infrastructure spending is going to create domestic demand as well. So really, it's fertile ground for investment in European stocks.
Are we confident that if the U.S. markets if the U.S. market rolls over, how diversified will these other markets be? What are the correlations going to look like? It feels like correlations are starting to break down a little bit at the moment, but do they tighten up if we do see the U.S. rolling over?
Could be. It could be. I think that's where, you want to have geographic diversification beyond Europe, right? So markets that we're looking at include India, China. For us, India is a fantastic growth story. You have the demographic growth story there where the middle class is expected to continue to grow and fund domestic demand, domestic equity exposure as well. That's quite low. It's only 5% or so. You have a pro-growth government as well. They're cutting taxes, increasing spending. And let's remember that the Indian market is also quite domestically focused. So it's not as exposed to, say, factors like the U.S., like Europe, for a global growth slowdown. So that's where you want to get that kind of diversification to reduce those correlations.
Great to see you. Thank you very much indeed for stopping by and seeing us. Nika Benami, Portfolio Manager, joining us from Julius Baer. Okay, what are we going to talk about next? We're going to look at the outlook for emerging markets. Phoenix Kalen from SocGen is going to be joining us. We'll get her take on what is happening with the yen as well. Busy week coming up, lots to discuss. We'll do it next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Not
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. 90 minutes past the hour. Let's talk about what's happening in the currency markets around the world. The yen recouping some of last week's losses. This as Japan's Prime Minister vowed to stay in power, given he's just suffered a huge defeat in this weekend's upper house election. The LDP no longer controls the upper or the lower house in Japan. I don't think we've seen that, well, since the LDP was created back in the 50s. Phoenix Kalin, head of emerging market research at SocGen, corporate investment banking, joining me around the table. Not really your bag. But how do is the yen trade a safe haven trade? Is it a risk trade? I'm just kind of wondering how you see it right now. More uncertainty in Japan. Do I buy the yen because actually it's sold off recently, or do I buy the yen because actually when things get tough, you used to go to the dollar, but increasingly now you go to the yen?
Yeah, I think it's still broadly classified within kind of the space as the euro. Safe haven, benefiting from flows away from the U.S., and we certainly had better than expected outcomes from the elections. So that's provided a bit of a bid back to the yen.
I've been on vacation for a couple of weeks. During that time, the dollar's had a little bit of a comeback.
Yes, about 2%.
Yeah, it's reasonable. Is it solid? Is this something that continues, or is this something that you can just chalk up to maybe the middle of the summer and nothing really going on?
So, I mean, we've got August 1st coming up. That's the deadline for a lot of these negotiations. Let's see if we get another extension. But there is going to be, I think, a little bit of nervousness, volatility, especially now that we're in kind of this summer illiquid period of the markets. So I think it can be a little bit choppy, and we can see a bit further give back in terms of EM currency and fixed income performance in that lead up to August 1st. And but after that, I think the question is around, you know, how much repricing further we see out of the Fed in terms of the rate cuts that are priced in. So
you see quite a bit. So you still only got one, right?
Yeah, so we think there's only one cut coming up from the Fed in December. And that means basically that there's still about 20 basis points worth of repricing that needs to come out. And that can provide a little bit more juice to this dollar trade. And then the positioning side is still quite unfavorable for EM currencies to outperform in this space, because people have gotten so kind of bullish on EM versus on the dollar. You know, the consensual view around dollar has been much more bearish over the past couple of months. And so I think that kind of sentiment and positioning has been unfavorable for this kind of illiquid market conditions.
Does vol pick up? Does volatility pick up?
So vol has struggled to pick up.
Oh, that's amazing.
No, yeah. So, I mean, we've tried to look at stuff like, you know, trying to go long EM vol in certain trades, but it hasn't really worked out. Even beginning of last week, when you had kind of a 0.2, 0.3 kind of vol pickup in the really impacted markets like Brazil, Mex, Colombia, Chile, it struggled to hold those levels.
So why is that happening?
So I think fundamentally investors are still very bullish, the kind of outside US story, the diversification story. And even though the flows have been structurally quite slow to kind of materialize, they are happening. We are seeing kind of more interest in Asian investors investing in Europe EM, in Europe DM as well, in LATAM, lots of flows into LATAM. And on the flow side, we've seen a quadrupling of flows into emerging markets portfolio debt in June. So quadrupled from the April and May figures after kind of that Liberation Day chaos.
But it feels really stable. Yeah, we had the chaos, but now we're in kind of this. Does that crack at some? Does August the 1st crack that? Do we start to see greater nuance being applied to different markets as well? Does inter EM pick up more in terms of the volatility? I feel like we're in this kind of incredible environment where everybody's super calm, or it appears that everybody's super calm on the surface, and I can't believe that that's not going to change.
Well, so, I mean, in terms of the market's disbelief in kind of the August 1st deadline, I think some element of that is quite credible because you've got lots of legal issues around some of the tariffs as well,
Sure.
kind of the IEEPA and reciprocal type tariffs. They are facing lots of legal challenges. The more credible ones are the sectoral ones, and I think the market does lend a bit more credence to that and does weigh on those economies more in terms of, the places where autos are being targeted or copper is being targeted, you see a more sustained impact. So I think there is definitely a differentiation between the types of tariffs that are being levied.
So you think a more nuanced picture starts to emerge?
Yes, and then, I mean, August 1st, that's 10 days away. We're not going to get that many deals done, and it's all kind of types of memorandums of understanding, just very high-level pacts. So the details won't be worked out for months, if not years, actually.
So what do we do? What do I...
So fundamentally, I think the outlook is still very favorable for emerging markets if you're looking at kind of the growth and inflation backdrop. So global growth decelerating a bit, China data getting a little bit weaker. They are in need of much more stimulus in the second half of this year for them to kind of meet those growth targets for this year. And then inflation side, we're seeing a pickup in the U.S., but we're not seeing a pickup elsewhere. And so,
is it inflationary in the States, deflationary elsewhere? Is that a reasonable kind of way of painting this?
Well, that's what's actually been happening, and we are actually seeing some deflation creep back into the China data as well. So yeah, excess supply is a big problem for the rest of the world versus for the U.S. So I think there is that kind of component of deflation creeping through, or disinflation creeping through to the rest of the world. And then I think in terms of what EM really worries about is a real rate shock out of the U.S. And despite the move that we've had, kind of a 25 basis point move across the curve in the past 2 weeks, that's not a real rate shock. That's been driven mostly by rising inflation expectations. So 5-year break-evens, that's gone up 24 basis points in the past 2 weeks. So pretty much matching the nominal rise that you saw in U.S. rates. So I think that's really the story behind that move. And so investors on the EM side really shouldn't be concerned about that because that's not a real rate shock. We still have very favorable kind of real components on EM, on the growth and inflation fund.
So which currencies am I looking at? Where am I going to see the outperformance?
So we still love LATAM currencies. So we've got on a basket trade, which I think is a good way to diversify when you've got lots of risks coming out of the Trump administration about how they might target individual economies. So we've got a basket trade where it's long, equal-weighted Brazil, Mex, Colombia, and Chile against the dollar, so short dollar. And that's been able to withstand this kind of market volatility. I think that's one good way to kind of think about thematic themes that are maybe less favorable for the U.S. and more favorable for the rest of the world, but do it in basket kinds of expressions. We've been trying to look at long vol. It hasn't really worked out well yet. We still like other short dollar positions, like short dollar versus CEE. And then I think after this little bit of market wobble in the summer period, we would be looking into receiver positions in places like Brazil, South Africa.
Looking forward to seeing some of those trades maybe working out. Felix, nice to see you. Always great to see you stopping by. Felix Kalin, Head of Emerging Market Research at SocGen Corporate Investment Banking. Coming up, we're going to turn our attention to what is happening in Germany. Germany's biggest companies pledging hundreds of billions of dollars in investment. We're going to talk about that next. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning. Welcome to the Pulse. I'm Guy Johnson in London. Let's talk about your top stories this morning. The Japanese Prime Minister vowing to stay on despite a historic election setback that saw his ruling coalition lose its majority in the upper house. They don't control the upper or the lower house now, which is the first time that's happened since the mid-50s. EU officials are set to meet in the coming days to plot a possible no-deal scenario with the US on trade. Washington very much hardening its stance on tariffs over the last few days. Plus, Ryanair, its stock rocketing this morning. Stellantis stalling. We'll give you a key roundup of some of the stories that you need to be watching on the corporate front in just a moment. But let's turn our attention now to what has been happening in Germany this morning. Dozens of Germany's biggest companies have joined the government to launch a new investment drive worth at least 100 billion euros. Deutsche Bank and Siemens are amongst those companies that are leading this investment alliance. The objective here is simple: to revive Europe's biggest economy.
I think it's quite impressive what we have collected after a couple of months with over 600 billion of investments, 61 companies. And to be honest, I think more to come over the next months, but it shows what the sentiment is and that we have a chance.
The Deutsche Bank CEO, Christian Sewing, speaking to Bloomberg's Olli Kruk a little bit earlier on. Olli joins us now out of Berlin. Olli, talk to us about what is happening here. This is the corporate story in Germany coming forward and saying, we want to invest, we're going to take your leadership and we're going to follow it up. Talk to us a little bit about kind of the scale and the intent and how far this could ultimately go.
Yeah, so this is an initiative that was really spearheaded by both Roland Busch, the CEO of Siemens, and Christian Sewing, the CEO of Deutsche Bank, to really come together, this sort of initiative called Made in Germany, to try to get these companies to pledge money to invest in Europe, to invest specifically in Germany. Because, Guy, as we know, there's the amendment to the debt brake, there's all the spending that's going to happen in Germany from the government level on defense and infrastructure. That could be more than €1 trillion. But at the end of the day, that's only worth so much. That can drive things only so far forward. What you need is the private investment. So this is more than €500 billion worth of investment. I mean, they are saying that this is not really sort of Trump-level accounting. This is sober German accounting. You know, Trump says, you know, there have been $14 trillion worth of commitments made to the United States. There's some question about the veracity of those claims, but that is the sort of moment of opportunity here for Germany. There is, however, also, Guy, the risks also on the horizon, namely that of the trade war and tariffs, and that could potentially blow things off course. Have a listen to what Roland Busch, the CEO of Siemens, had to say about the threat of tariffs here in Germany.
There's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts.
And when we were speaking a little bit before the interview, he was saying that basically an okay deal on trade in the next couple of weeks, even if it's not the best deal, is going to be better than another 12 months of negotiations and sort of paralysis on this question of tariffs, because companies can begin to actually make decisions. It's something we hear from a number of different companies. There is, however, not just the risk associated with what the United States is doing, there's also an opportunity there. And that I got from Christian Zaving, the CEO of Deutsche Bank, in appraising kind of this sell America, buy Europe trade. Have a listen to what he had to say.
There is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. We have very strong US banks, very capable US banks, but in this world of geopolitical uncertainties, they want to have a capable global European player.
So in the sort of vast balance of risks and opportunities that are facing the German economy right now, this initiative is really something that's being driven by the German private sector in trying to capitalize to some of the momentum that we're getting here from the German side, really getting buy-in from the political side, the private business community, very happy with what they're seeing with the government amid the risks that are also on the horizon, and really just trying to insulate the German economy and trying to really reimagine it, Guy, for what it looks like the next 10, 20 years from now. It's going to be very, very different from what it was in the last few decades and what really drove wealth in Germany over the last 50 or so years.
Ollie, great stuff. Thank you very much indeed. Really enjoyed the interview. Thanks very much indeed for updating on the takeaways from it. Let's carry on the conversation around this infrastructure story. Philippe Christopoulos, a global co-head of Global Industrials Group and global head of infrastructure and power at UBS, joining me around the table. Perfect person to pick up on what we've just been hearing about. Good morning.
Thank you very much for having me.
Is this a German story or is this a European story? It's the first question I want to ask, because I hear a lot about Germany at the moment. I hear about the investment that German corporates want to make. If I go across the border into France, it feels like a very different narrative. So are we confusing at the moment a big German investment drive with a European story that looks more positive? How nuanced do we need to be here?
The reality is today, on the back of the European Union, when you think of the big engine rooms, Germany has always been one of the key factors. And so it's sometimes difficult to completely separate Germany from the rest of Europe. But I do think that Germany will be the driver of this change, and it will affect overall momentum across Europe.
This is a conversation that we're having at the moment between German corporates. Ollie was talking to Siemens and Deutsche earlier on, and the German government. Yet there's also this kind of broader pull by European corporates. And the message they're sending to Brussels is, come on, get on with this. We've had the Draghi report. We've got all this other stuff going on. We need to act, and we need to act boldly. Is what we've seen so far Europe acting boldly? Is there more bold action still to come?
So interestingly, I think Europe has always managed to thrive in times of crisis.
Yeah.
In a benign environment, they seem to not make big decisions.
Yeah.
I'd like to think that this is a beginning of a bigger shift, and the German headlines will clearly be critical in pushing the European shift. What's interesting about the European headlines is it's largely focused on airspace and defense and the infrastructure space as well. And it's not uncommon for governments to use infrastructure as a way of resetting, of propelling their economy. Infrastructure has multiplier effects, whether it's called labor, whether it's called supply, improved efficiencies. And so the German government is focusing on that. And I think Europe, has made similar headlines, much smaller.
Yeah.
I think the difference with Germany is the scale at which it's happening. And it's clearly creating a shift in how investors on the private markets are going to look at this opportunity.
Where are the opportunities? Because what I still hear from corporates in Europe is still too much bureaucracy. Still, that's a problem. Europe needs to deal with that. But the other thing I hear a lot about is still energy. And where do you think, outside of defence, that the opportunities lies? Is it about reducing Europe's energy costs? Where is the big opportunity still that exists that gets Europe into a position where it can thrive in a much more self-sustaining, positive way?
So the headline is infrastructure. If you break down infrastructure is not just about bridges, roads, and rail.
Yep.
Infrastructure today is much broader. It includes AI and creating the right infrastructure with data centers.
Sure.
It means electrification, EV charging, but also the need for power to power these data centers.
Yep.
Energy independence. These are massive, these are real mega trends that are cutting across Europe and across the globe today. And so the needs are significant. And you see capital coming in to fill these needs. The infrastructure funds today are some of the largest players in private capital markets.
How much further do we have to go? How much more capital is required? Where are the bottlenecks? Because you can push capital into a market, but sometimes it gets stuck, and you end up with it being applied in the wrong places. Where do you see where is the challenge right now? Because actually, what it doesn't feel like at the moment is the problem is availability of capital. It feels like it's actually pushing that capital into the right places.
I actually think that's absolutely right. You need a pull and you need a push. And right now what you're seeing is they're trying to create the pull. You know, these headlines are effectively trying to incentivize private capital to come alongside the government to fund investments, both in defense, but also, importantly, in the broader infrastructure space. The push needs to have the right incentives and the right platform to do that. I think there's work that's required there to make that investment easier or to make the barriers less difficult.
Yeah.
But I think Germany is making, more than just a big number. They seem to be creating an investment through a setup that will allow private investment to come alongside it, whether as co-investment or as government guarantees that might be coming to incentivize the private investment. So I think they are creating the right backdrop. But how is that going to translate into M&A? I think that's still TBD. I have no doubt it will translate into an increased M&A activity around the infrastructure space more broadly in Germany.
So do we get bigger, stronger companies? Is that the net result of all of this?
We'll get a better infrastructure backdrop over the next decades, or more, and that's a necessity. We cannot remain the way we are, and when you look at, again, in data centers, just there's over $1 trillion of investment required over the next 5 years.
Yeah,
that's massive. In the capital around electricity, the same thing. Power has been flat for the last decade. Power generation and power demand. It's increasing now, and it will increase even more going into the future. All of these things will only happen if you put capital in. And infrastructure funds today have massive amount of capital to invest in these assets.
But I still hear about the bureaucracy. I still hear that it's a challenge to get it done here. Yes, the money is coming in, but executing on the platforms and the projects is still difficult. Trying to get stuff done is still difficult. Are we moving fast enough in cutting the barriers, the red tape, to getting some of these deals done at a time when Europe has this determination to do more, but seems to be just tripping over itself in terms of executing on that?
We never move fast enough.
No.
Across a broader infrastructure space and across removing the red tape. So the short answer is we can do and we should be doing a lot more to improve and facilitate the capital deployment. But again, these headlines, I would like to think, will help also Europe move in the direction of removing that red tape to allow for infrastructure funds to deploy capital in this space. And that's a necessity.
How long a trend is this going to be? Like, how long does this last? Because Europe historically has this kind of, Europe gets on the front foot, but it doesn't last very long. Is this, you talk about mega trends, is this a trend that is sustainable?
Absolutely. Again, if you think about the underlying mega trends, these are things that are imperative to happen. It's not a good to have. It's a must have. And therefore, when you look at the future, it will undoubtedly happen, and it will have to happen in a very short term. As I said, AI, electrification, but even our own airports here in London, same thing. Right? So there's a need for capital that needs to happen quickly.
Philippe, great to see you. Thanks for stopping by to see us. Really appreciate it. Perfect timing. Chrissy Kokopoulos joining us, Global Head of the Global Industrials Group and Global Head of Infrastructure Power at UBS. Let's talk about some of the other stories we're watching right now. Israel has warned it will move for the first time into a town in the heart of the Gaza Strip that had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians to evacuate southwards away from the area. Officials in Gaza say a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 Sunday, Witnesses said Israeli tanks fired shells towards Palestinians awaiting the entry of food trucks in northern Gaza, an area that has seen intense clashes with Hamas holdouts. The Washington Post is reporting that a Chinese-American employee of the U.S. Commerce Department has been barred from leaving China since April. According to the South China Morning Post, he traveled there to visit family and was detained when he arrived in the city of Chengdu. The Washington Post cites sources saying the man is being held because his case is linked to actions Beijing considers harmful to national security. And hackers are reportedly said to have exploited a major security flaw in a widely used Microsoft Server software platform to launch a global attack on government agencies and businesses in the past few days. According to the Washington Post, the US is amongst countries investigating the compromise of the SharePoint servers, which provide a platform for sharing and managing documents. Coming up, we'll talk about what is happening in the aviation sector. Profits at Ryanair have more than doubled in the first quarter. This, as the airline says, it's recovering from last year's drop in fares. More to come on that story shortly. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Earnings season is here.
The focus is on the European earnings space.
A busy week of corporate earnings.
We're going to be deeply into a lot of these earnings stories. Bloomberg is first to break the numbers.
Santander, Caixa, Soc Gen,
Deutsche Bank, HSBC, BBVA.
A slew of bank earnings already out.
With the smartest insights.
There's an earnings revolution going on.
Markets are going to be driven more by earnings.
It looks like the worst is behind us.
Continuing coverage on Bloomberg. Context changes everything.
Different routes across the network, including 160 new routes this summer. All of those are booking very strongly. Fares are recovering nicely. We would expect to recover almost all of the 7% fare decline that we had in the second quarter last year. So, you know, we're seeing no softness in people who want to travel. We have limited growth this year. We're only growing by 3%. It's 206 million passengers. But demand is exceptionally high, and we have no qualms about hitting that target this year.
CFO of Ryanair, Neil Soren, speaking a little earlier to Bloomberg, Europe's biggest budget airline, reporting a doubling of net income in the first quarter. Strong numbers. Actually, the share price reaction has been very strong as well this morning. Let's bring in Bloomberg's managing editor for global aerospace and defense coverage, Benedict Camel. Benny, let's start and talk a little bit about Ryanair and what we're getting this morning. The market clearly very pleased with what we're hearing. This is in some ways a capacity-constrained airline. We're also seeing capacity constraints elsewhere in Europe. Is that why maybe we're seeing a bounce back in the numbers that we're getting right now?
Yes, this is a really good market for Ryanair to be in. This is a market for frugal travelers. We're heading into the summer period. People want to get out. And as you say, we are capacity constrained. We're capacity constrained among the rivals. EasyJet's having issues. Wizz Air's having issues. So that really helps Ryanair. They did have a tough spot over the last year with the intake of their Boeing aircraft. That seems to be behind them. We heard from the CFO this morning. He said he's very happy with how things are progressing at Boeing. We're 1 year into the new CEO tenure of Kelly Ortberg, and it feels like he has managed to turn things around. There's a better cadence, a better tempo in terms of the aircraft that they're delivering to customers, and that includes Ryanair, of course, which is their biggest customer in Europe, to a point where they say, we still have aircraft coming next year, but we don't have to take them necessarily. We're in a good place right now. So all of that is really helping the airline right now and the outlook.
You do kind of wonder, and the share price maybe reflects this morning, that actually the lack of capacity, the lack of aircraft that has come out of Seattle has helped in terms of their ability to bounce back from that fare dip. And the market was really shocked, what was it, 6 months, 9 months, a year ago, when Ryanair came out and said, actually, we're seeing some softness in fares. That seems to be firmly in the rearview mirror.
Yes, you're right. So the situation coming out of Boeing is looking much better. The situation over here is also good for Ryanair. So the fares are creeping up again. That's a good picture. But capacity remains under control to a point where they can really manage that. The demand into Southern Europe remains strong. Into Scandinavia, we're hearing that's really going very well. They've pushed extra capacity and extra routes into Scandinavia. They're sort of going after some of the areas that they feel are conducive to their business model, so low cost, low taxes. Germany is not one of those places. Germany is actually one of the markets that's not really doing very well for Ryanair, but they have options to go elsewhere, and they're really pushing that.
The first headline I read this morning was the fact that Alaska, over in the United States, Alaska Airlines had a ground stop this morning. It looked like it was an IT issue. What do we know about that?
So that seems to be it. It seems to be that the IT issue is now behind them. But the bigger picture really is how creaky is the software in the US aviation market in particular. It's something we've seen routinely over the years. It's sort of this rolling issue. Usually they manage to get over it fairly quickly, but Alaska Air has been hit by this several times now. There's also been IT hacks. So all of that raises the question, like, what kind of an upgrade does the system need, both at the airlines proper, but also on the ATC side? We know the US government is trying to do something about it. The new bill allocates quite a lot of money towards upgrading the system, but these things take time. And then what you see is what we had at Alaska, thankfully fairly short-lived, but it's a reminder that this is a system that's often been sort of patched together over the years, and to renew it costs a lot of money, it can cost time, and then you have these issues.
Benny, thanks very much indeed. Benedict Camel, Managing Editor for Global Aerospace and Defence Coverage here at Bloomberg. Let's go from planes to cars. Stellantis reporting a $2.3 billion net loss in the first half as restructuring expenses, falling sales and US tariffs hit the struggling automaker. Craig Trudell here to talk about that. New CEO. I kind of read the statement this morning, and you kind of look through it and you're thinking, this feels like a CEO that's come in, looked at the numbers, said, right, let's clear the decks, figure out where we go from here.
Yeah, more than a few analysts we've seen refer to this as a bit of a kitchen sinking on the part of Antonio Filosa. He does, of course, have a lot of issues to work through that he inherited from Carlos Tavares, who the board moved out of his role late last year. And I think this is a reflection of a company that was without a CEO for much of the first half. It is really sort of lost from a perspective of where they are with their lineup. They were trying to make this pivot and this change to electric vehicles with a lot of brands that doesn't really jive very well with or easily with in terms of Ram trucks and Jeep SUVs. So some of this 3.3 billion euro charge that we saw the company report this morning has to do with canceling programs. What I think we may see, given where fuel economy standards are going in the U.S., is sort of bringing back Hemi engines, bringing back some of the gas guzzlers that the company can now sort of get away with bringing back into the fold and sort of put off having to make that electric transition.
Okay, let's talk about what else we've got on deck this week. Talking of electric transitions, let's talk Tesla. What is the bigger picture that is emerging from the also story? We've got Volkswagen as well this Friday. I think they're out with numbers. What's the bigger picture we're looking at?
Yeah, I mean, I think, the implications of this federal pullback in the U.S. is really going to be far-reaching, where, you would think on the surface it would help a company like Stellantis, and yet they were spending all of this money to bring, electric vehicles to market, investing in batteries. With Tesla, you have a very different story where they were really able to sort of benefit from the fact that these rules were getting tougher. Established manufacturers were having trouble making this change. Now, sort of the pressure is off these companies. The regulatory credits that they used to have to buy from Tesla, they no longer, may need to buy any at all, or at least as much. And so, just how much that's a real issue for Tesla going forward, given the fact that over the years they've earned something like $12 billion in revenue that has been, out of the pockets of their competitors and into the.
It's amazing. Every time you look through the numbers and you see that figure, you're like, how on earth is this possible? And are you making cars or are you just doing credits? It does sometimes feel like that. Craig, thank you very much indeed. Our Autos editor, Craig Trudell. Let's talk about the other sector that we're going to be spending a lot of time talking about this week, and that is going to be the European banking sector. We've got a series of numbers coming up over the next few days. Chloe Melly joins us to talk about that. Deutsche first. Let's talk about Deutsche. What are we expecting there?
Yeah, so the CEO has said a few things recently that we need to kind of keep in mind going into the results on Thursday. So he said just today that companies and individuals, amid all of the kind of tariff uncertainty, were trying to seek an alternative to US banks and really refocusing on European banking. So we'll see how much that kind of feeds through and is reflected in earnings. At the same time, he also said recently that there had been quite a rocky start in the trading business at the start of the second quarter, and also weaker than expected performance in the advisory business. So based on all of that, it seems like there might be some disappointment with numbers, but some bright spots, including particularly in the corporate bank we expect.
What other banks are we going to be watching?
So we're looking for BNP Paribas also later this week, and NatWest and Lloyds, and then we have a few others next week coming through. The main thing to look out for this particular season is that after quite a resilient first quarter, we expect the second quarter will be a bit tougher. So obviously we've got the trade war, we've got recession fears, interest rate cuts. All of that is feeding through into lower net interest income. We've already seen that with Nordic banks. A higher cost of risk. It's also impacting deal making. So all of that we're kind of keeping an eye on. The read across from US banks shows that maybe there might be a bright spot with banks in Europe that have a really strong investment banking division, like BNP, SocGen, Barclays next week as well. And then UK banks, Lloyds and NatWest, might be doing a little bit better than their peers because they have structural hedges that kind of protect them from the impact of rate cuts. So they're kind of shielded a little bit better.
Chloe, great stuff. Plenty to look forward to as we watch what's going to be happening with the bank reporting season. We'll bring you all those numbers, of course, as we work our way through that over, I don't know, the next 10 days or so. Quick look at what is happening with US futures right now. This is the picture we find ourselves with. A little bit positive, but not by much, actually, this morning. You do feel as if we're searching for a catalyst first thing this morning. We didn't get really one out of Japan first thing. Japanese markets are also closed, Marine Day. But we've got an awful lot coming up. We've got the ECB this week, plus we're also counting down towards that tariff deadline as well. So plenty still to work our way through. But US futures at the moment, broadly positive after, I have to say, a very flat end to last week in terms of the Friday session. Up next, Danny Berger and The Brief. That's what you've got to look forward to. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. Europe prepares for a fight. Less than 2 weeks until the U.S. trade deadline, the EU gets ready to push back. Ishiba holds on. Japan's prime minister vows to stay on to negotiate tariffs despite his party's historic day election loss. And Europe kicks off a busy earnings season. Stellantis books a massive loss. For the U.S., it is big tech earnings on deck. So yeah, a busy week, the second busiest week by market cap for U.S. earnings. We get Alphabet this week alongside Tesla on Wednesday. And the summer melt-up continues into that. We're up by about 0.25% for both the S&P and NASDAQ. We're a little changed on Friday, so should we open here, we'll be at other all-time highs. Now, for this bond market, what a volatile and crazy week, I guess we could say last week, from questions about Fed independence to picking through a CPI report to trying to see where tariff inflation hit. We are met with a rally this morning after positive UMISH data last week alongside Chris Waller, the Fed governor, calling for lower rates, lower by about 2 basis points on your 2-year yield at 3.8, your 10-year yield lower by more than 3 basis points at 4.38. Let's get you now some stocks that are moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with a check on Stellantis. I know you just mentioned it there at the top. Down 1.4%. Their ADR is trading lower in the U.S. pre-market. This comes after they released some preliminary figures for the first half, pointing to a loss of 2.3 billion euros. There was some color of a impairment charge of around 3.3 billion euros that they gave detail. Now, Stellantis does report full results next Tuesday, so we'll await those as well. Moving on to stocks included in the S&P 500. One of those being added is Block, the payments firm Block. This is the owner of Cash App and Square. Those shares are up 9% so far in pre-market trade. That passive bid might help out this stock's name. It's going to be replacing Hess in the S&P 500. Now, Hess was acquired by Chevron on Friday, so that stock has now delisted. Lastly, let's move on to Alaska Airlines. Those shares are trading just slightly lower here, but they, unchanged, my bad, unchanged on the moment, but they did have to ground their flights, Danny, for 2 hours overnight due to another IT outage. This is the second IT outage for Alaska Airlines that's grounded its fleet this year. Danny.
Valerie, thank you so much for that. That is Valerie Teitel. We'll catch up with you later in this hour, and in just moments, Max Kettner of HSBC will give his current read to us on market signals later this hour. Amy Silverman of RBC joins to discuss another big week of earnings. Now, futures are rising ahead of a busy earnings week. Max Kettner gives us his read on the market right now, writing, quote, "There are some warning signs emerging. Specifically, our short-term sentiment and positioning signals are now sending a sell signal, and in fact, the biggest one since mid-2023. I'm pleased to say that Max Kettner joins us now. He's Chief Multi-Asset Strategist at HSBC. Max, really wonderful to speak with you this morning. It wasn't that long ago, in fact, the start of this month, that you doubled down on your overweight U.S. equity calls. So balance that with the concerns you're seeing on a more technical level now.
Yeah, good morning, Danny. Look, I think from a fundamental perspective, I think this rally can still go on a little bit further. I think equities still have, particularly in the US, a little bit room to run further, particularly with that reporting season. Let's remember that we're going into this reporting season with very, very low expectations. We've started it with consensus saying that earnings are going to drop sequentially, that they're going to see a quarter-on-quarter decline, even in tech that is so buoyed by by things like the weaker dollar, but also by continued capex spending on the AI side. Even there, consensus was saying we're only expecting flat quarter-on-quarter growth. So therefore, I do think the next couple of weeks still well supported. I do think we still can rally a bit further. But I think heading towards September, there's probably a bit more questions marks, like you said, around the technical side, around the sentiment and positioning side. Clearly, things are getting a bit more stretched. I do think long onlys, at least on our data, a lot of them have missed the rally. There's still a lot of subdued sentiment, barely any overweight in equity, actually still underweight on high yield on aggregate. But at least the shorter term signals from us are really now starting to flash. Again, that doesn't send an immediate sell signal, doesn't mean that we need to immediately get out. But I do think, in the next couple of weeks, put a couple of hedges on some of the cyclical parts of the market. Think in Europe, things like the auto sector. You were just talking about Stellantis, that sort of almost 10% rally, that 10% squeeze that we had earlier this month. Use those kind of squeezes, particularly with vols, how low they are right now, with those low vols, really to put a couple of hedges on and lock in some of those gains.
Max, it is a bit different from what you've been saying, especially for the second half of the year when you've been really bullish. And I feel like what you've really been communicating well is that this market has been missing a lot of things that can go right. But the title of your note that you put out this morning is "What Could Go Wrong in the Second Half?" Max, is that also an acknowledgement that there are greater risks to the downside right now than there are to the upside?
Well, there has to be, right, Danny? If you're as bullish as us, so we were around the table, was like, do we have any upside risks? And like, actually, no, because we can barely be any more bullish. So from that starting point, to have even upside risks, I think would be probably not the most prudent thing to do. So therefore, I think, but by definition, there's really only downside risks. There are some of them that I am genuinely concerned about. Of course, things like yields going up again because growth is too good, or maybe goods inflation goes up. Fine, that can send us down a couple of percent, but ultimately, those are the kind of buying signals. The same thing is on the technical side that we were just talking about. That sentiment and positioning, once it gets too stretched, you know what, just put a couple of hedges on when vols are very low, and then something might be happening, right? I don't know, Trump saying something, or perhaps it's something on the Fed side of things, then obviously there is a bit of a higher height to fall from, but that doesn't mean the end of the rally. I think there is more fundamental things that I'm concerned about. Perhaps, for example, something like a retightening of the labor market, but for the wrong reasons, for the reasons of immigration flows going into perhaps even negative. That really would be something that fundamentally would make me concerned. Everything else is sort of tactically and technically driven pullbacks.
Max, is it a market more sensitive now then? Because it has been a market that's looked at tariff disputes, a lot of other concerns, and really has been able to brush it off. That has been extremely resilient in this melt-up we're seeing. Is it also your concern that that type of resilience, that type of lack of sensitivity ends as well?
No, I think let's talk again in a month and a half. Let's talk after the summer holidays. I think then, maybe I'll ask a bit differently. I'll answer a bit differently. But for now, I think it's this setup of the wall of worries plus really those really low earnings expectations that we had ahead of the Q2 reporting season that can really get particularly the mega caps and the large caps in the S&P 500 really going in the next couple of weeks. I think that really overshadows any kind of tariff headlines, any kind of Fed headlines that you were talking about earlier on as well. That's really the much more important thing, because again, I would be much more convinced, much less convinced about this if we went into this with earnings expectations of like 10% plus for the tech sector, but flat earnings growth with now an even weaker dollar and still pretty strong AI capex spending. That really is a setup that in the next few weeks into those earnings seasons, you don't want to go short into that. After sort of end of August, September, I think it's a different thing because then there might be some more clouds coming on the fundamental basis, not necessarily tariffs, not necessarily the Fed, but much more sort of from a growth inflation mix backdrop.
It has been interesting, though, to look at a bond market that's maybe been more sensitive to some, at least, of the inflationary concerns coming out. I mean, I know there's a lot in this bond market right now between Powell and all of that, but we saw a 30-year yield go back above 5%, a 10-year yield hover around 4.5%. If it is an equity market that it is ignoring inflation at the moment, at what point do higher bond yields need to reawaken the concern that other risk assets maybe should be moving in lockstep with the bond market?
The answer is 4.7% on our estimates. So it's not, I've not just made that level up. It is slightly more sophisticated. So we've got a model called the danger zone, this danger zone where really it starts hitting all risk assets at 4.7%. Anything north of that on the 10-year will start to hit risk assets. One thing that we always got to remember with the bond market versus the equity market or with risk assets overall, the relationship is highly nonlinear. It's very, very asymmetric. It doesn't matter. Higher yields don't matter until they are the only thing that matters, right? So, which sounds very stupid, but it's basically, it's not a relationship where you say, wow, bond yields are up 5 basis points, therefore now equities need to suffer. No, it really depends on, number one, the level, what kind of level there is where it really starts stoking fears in risk assets overall, and it depends on the velocity, how much it's going up, not only on one day, but really over a month. That is sort of 25, 30 basis points over a month. Once that hits, then, you know, we're going to that danger zone and the level is around 4.7% on the 10-year. That's when we start to get more concerned. Until then, we can thoroughly ignore it. And it's still quite, you know, quite a nice backdrop where yields can go up, but risk assets can still rally.
Hey, Max, just quickly, because I really want to squeeze this in. You also wrote in your note this morning that ironically, tariffs could be the next bullish catalyst. We only have about a minute left, but what do you mean by that?
Yeah, it's not my desperate German attempt of being funny. It's not that. So it's slightly, you know, again, slightly more sophisticated. Let's be honest around tariffs. You know, around the 9th of July, there's been a lot of hedges, a lot of concern around that. And just one tape 2 days before, you know, we've had suddenly a new deadline reinstated. Let's not forget that this whole tariff issue, particularly the deadlines, they are not deadlines that are set in stone. They are not deadlines like the debt ceiling. They're not, you know, mandated by law. Absolutely not. There's nothing in the way that in the next week or two, we could perhaps see really the administration saying, look, we actually are having really great negotiations with China, with the European Union. We just need a bit more time. Let's make a new deadline on the 1st of September or 1st of October, or maybe we won't have any deadlines. You know, already Besson, I think, was on with you guys on Bloomberg TV last week saying, look, and he said, look, I'm telling market participants not to worry too much about the US-China deadline. So already he is saying, yeah, it's actually not as much of a deadline, or not the word deadline per se. I think that is one thing. Again, it's one element in the wall of worry is that people perhaps are taking a little bit too literal. They take it almost as economically inevitable. Whereas in my mind, it's a self-imposed thing that could actually just be extended by another month or by another 2 months. And is another element of the wall of worries that would then be taken out, and we could, as a result, see another squeeze higher.
Hey, Max, thank you so much for joining this morning. By the way, a belated congratulations. I saw you were voted #1 as a multi-asset analyst in 2025. Well-deserved. Max Kettner of HSBC. Looking forward to chatting again soon. All right, let's get you now some other top stories that are trending on the terminal this morning. Stellantis reporting a net loss of $2.3 billion in the first half. Restructuring expenses and U.S. tariffs hit the automaker. In North America, shipments fell 25% in the second quarter after a series of cost cuts. The new CEO attempting to clean house and stop a slump in sales and earnings. Elsewhere, Ryanair said that it will recover most of the fare drop it suffered last year, aiming to achieve reasonable profit growth in fiscal 2026. It did, though, caution that second quarter fare increases will be lower than in the first. Ryanair said travel demand is strong for the crucial summer period, helped by capacity constraints at other carriers. Meanwhile, Microsoft Server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. Microsoft said it released a new security patch to mitigate active attacks. Coming up, the EU prepares for no deal with the U.S. The U.S. is confident, though, that it can get one done. Your trade update coming up next on your brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
11 days now away from President Trump's August 1st tariff deadline, Bloomberg reporting that the European Union is preparing for a no-deal scenario with the U.S. For more, we're joined by Bloomberg's chief European correspondent, Oliver Crook. And Oliver, this also follows off the back of FT reporting that the Trump administration would be looking at a 15 to 20% baseline tariff for the EU. What is the EU planning in return?
Yeah, well, we don't know at what level of asymmetry the Europeans are going to retaliate on the Trump administration, and that is going to be basically the major conversation that is happening now between all of the capitals, the ministers, the leaders of all of these European countries, which is at what sort of baseline tariff rate does Europe basically have to respond. We know that the window basically for tariffs is going to be between 10 and 30% in the event of a no deal by August the 1st. As you say, there's some reporting that that narrows down to about 15 to 20%. But if you get a 15% or 20% tariff on the EU, will they retaliate? We know from the President of the United States, any kind of retaliation of 5% tariffs, say, then that gets stacked up on top of whatever the U.S. has put forward. And that has really been the debate going forward, is how hardball do you play? How much stick do you bring to the carrot in these negotiations with the United States? We got the perspective from some of the major companies within Europe on that. I spoke earlier this morning both to the Siemens CEO as well as the Deutsche Bank CEO. Have a listen to what they're saying about how the sort of trade war is evolving in their view of it.
There's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts.
Most of the companies are not trending away from globalization. They are simply saying, how can we diversify and making sure that we are not too dependent from one or the other country.
And so two perspectives there from two very different German companies. You have Roland Busch from Siemens basically saying that at a certain point, the uncertainty becomes worse than a bad deal with the United States. And Christian Zaving on the other side, which I think is really interesting, is saying that he's seeing a lot more interest from clients that are looking for a European alternative to U.S. banks, that this is one of the benefits, one of the silver linings from some of the instability we've seen in the United States.
All right, Oliver, really fantastic conversations you had there. I recommend everyone going onto the terminal at Bloomberg.com to look them on Germany's investment push. Oliver, thank you so much. That is Bloomberg's Oliver Crook. Now, coming up, Ishiba vows to stay on. The Japanese Prime Minister tries to buy time after yet another election setback. We're going to discuss that coming up next, and the yen's rally following that election. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. First up, on the New York Times, members of Congress from both parties say they want to see more files released on the Epstein case. Days after the Justice Department asked a federal judge to unseal grand jury testimony, both Democrats and Republicans suggested the move was insufficient. Next up on the Wall Street Journal, reporting that Treasury Secretary Scott Bessent privately laid out his case to President Trump for why he shouldn't fire Fed Chair Powell. Bessent said firing Powell was unnecessary because the economy is doing well. By the way, Trump pushing back on Truth Social, saying he knows what's best, and that's why stock markets are at all-time highs. And on the Financial Times, Japanese Prime Minister Ishiba said that he will continue to lead Japan. The Liberal Democratic Party lost its majority in both houses of parliament. For the first time, he spoke at a press conference after the election results.
昨日行われました
We, the Liberal Democratic Party, received a very severe judgment by the people in yesterday's upper house election. As the head of the Liberal Democratic Party, I apologize deeply for the upper house election result.
The yen strengthening against the dollar this morning, stronger by about 0.6% at 147.92 after the Prime Minister's announcement. Joining us for more on this story out of Tokyo is Bloomberg's Alice French. Alice, just how historic was this loss for Ishiba's party?
Yeah, so look, as you mentioned, this is not a good outcome for Ishiba or the LDP. Partly expected, I think, after they lost their majority in the lower house in October. But Ishiba and his ruling coalition failing to get those 50 seats that they need to maintain a majority in the upper house. That means he's going to have to move forward and rule the country without a majority in either house for the first time since the mid-1950s. So this is a pretty historic defeat. This comes amid a lot of sort of discontent amongst voters around the rising cost of living, inflation, etc. Like you mentioned, we did see the yen slightly gaining actually today. I think this is more on a kind of risk-off safe haven move and also partly some buying back after the weakening that we saw last year ahead of this election on caution. But we'll really see tomorrow how markets respond to this because it has been a public holiday here today.
So maybe when more liquidity comes back, you see a different reaction. But Alice, the fact is that there is now less than 2 weeks for a tariff deadline for the U.S. on Japan and all the other nations. What impact does the election have as those trade talks continue on?
Yeah, the timing is really tricky, right? And Ishiba's position now really weakened domestically is not going to set him up well for pushing forward with those trade talks. We know that Japan's chief trade negotiator, Akazawa, has been back and forth to Washington multiple times, that we haven't really seen any concrete outcomes of those trade talks so far. I've been speaking to people here today. There's a lot of worry in the market that this may weaken Japan's hand even further. We know that Japan obviously is very reliant on exports, particularly in the auto sector. So there is a lot of worry amongst investors here about how that might impact stocks here, what it might mean for the yen. And as you say, time is ticking, and this is only going to make things more difficult.
Well, it probably makes things more difficult for the BOJ. How do they handle policy when there is political uncertainty right now?
Yeah, I mean, I think the general consensus is that BOJ will probably have to push forward with those interest rate hikes at some point. But obviously, this policy uncertainty, particularly around government debt, is likely to perhaps slow down the pace of those hikes. I was speaking to some people today saying, you know, they were looking for at least one hike by the end of this year, and now the possibility of no hikes for the rest of 2025 has got higher. You know, government spending was a really big focus of this election. The opposition parties that have gained traction in this vote, several of them pushing for tax cuts to the consumption tax, concerns over how the government will fund that, particularly as Ishiba, you know, calls for more defense spending. So it's really, I think, casting a lot of doubt over the outlook for the BOJ and for fiscal policy in general.
Alice, thank you so much for that excellent update. That is Bloomberg's Alice French. And as we've been talking about the yen strengthening this morning, just under 150. Coming up, lack of conviction lingers in markets. We're going to catch up with RBC's Amy Wu Silverman, who outlines where the hedges are and are not. She joins your Bloomberg Brief coming up next.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday morning. Europe prepares for a fight. Less than 2 weeks until the U.S. trade deadline. The EU gets ready to push back. Ashiba holds on. Japan's prime minister vows to stay on to negotiate tariffs despite his party's historic election day loss. And Europe kicks off a busy earnings week. Stellantis takes a major hit. Big tech is on deck in the U.S. And the summer melt-up continues into that tech earnings season. Both Alphabet and Tesla report on Wednesday. Overall, 20% of the market by market cap. They barely moved on Friday, but here we go again, up about 1/3% for the S&P and NASDAQ. Russell 2000 outperforms. If we hold on to these levels, we will hit another all-time record today for this Treasury market. And probably part of the reason you're seeing small caps rally is because it is a Treasury rally. Off the back of some sizable bond market moves yesterday, questions of Fed last week. Fed independence, hawkish details coming from the latest CPI, all of those helping to push 30-year yields around 5%. We're under that this morning. Some of the curve steepening eases off today. 437 is where you stand on your 10-year yield. Let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start with a check on Stellantis that you did mention there. Those shares are down nearly 2%. They came out with some preliminary results for the first half, detailing a loss for the first half of the year, a $2.3 billion loss. There was some color about an impairment charge. They also had some color about their shipments to North America. Danny, the second quarter shipments to North America have dropped by 25% as this company continues to deal with Trump's auto tariffs. Let's move on to other companies that are going to be included in the S&P 500. This is a big win for Block, the payments company that owns Cash App and Square, up nearly 10% on the news that it will be replacing Hess in the S&P 500. This comes after Chevron acquired Hess on Friday. That successful acquisition led to Hess being delisted, and Block will be added to the S&P 500 effective on Wednesday. Lastly, some stocks to keep an eye on this morning that are reporting earnings before the bell. One of them is the big telecom giant Verizon, the first of the major telecoms to be reporting earnings this morning. Those shares are trading in the green. And one to leave you hungry, Danny, Domino's Pizza also reporting before the bell. Danny.
5:30 a.m. in New York, never too early for a slice of pizza. Valerie, thank you very much. Valerie Teitel there. Now, when it comes to the rest of this market, Amy Wu Silverman of RBC Capital Markets does see more room for them to grind higher, writing, quote, "Sentiment and positioning suggests a dramatic lack of conviction remains, but that also means if things come in better than anticipated, there is more room for investors to go jumping into the pool." An apt metaphor for a hot summer day. Amy joins us now, who's head of derivatives strategy at RBC. Amy, I think a lot of people wish that they were at a pool instead of at their desk trading these markets. I just want to start on the positioning, because here earlier in the program, we were talking to Max Kettner of HSBC, who said things are starting to look stretched and it's concerning him. So where do the differences lay? Where are you seeing that lack of conviction and maybe more upside to come?
You know, it's actually exactly that comment, Danny. I would call this a very reluctant rally. Folks know that valuation is stretched. People have been rather angsty given everything that is kind of overhanging. And because of that, you know, we've seen kind of this dichotomy between perhaps the retail investor base and the institutional investor base. I can tell you there's been more drag to that institutional investor base, but as things come in better than expected, you know, you have two big earnings this week from the Mag 7, there's sort of this forced jumping into the pool, if you will, because we still have this problem when things outperform that are high benchmark concentrations, you as an investor must participate as well.
This is interesting, Amy, this idea that it is uncertainty, because a lot of the conversation has been that it's complacency, that it's a market that simply doesn't care. Are you saying that that's the wrong narrative? It's just a market that is very uncertain where things go, so is kind of nervous to really bet one way or the other?
Yeah, look, I think it's fair for people to characterize complacency when you have a VIX kind of sub 17 handles. I would say two things. The issue has been that when you have been doing these consistent systematic hedges and the market continues to grind up, it's very hard to continue to hold them. That's not complacency. That's just the difficulty in the kind of being tactical about those hedging. I think, Danny, one reason that we see term structure and options heightened is because near term we are uncertain, but we haven't been placing those hedges well. But longer term, we are still quite worried. And then the second part of that is we are going into August where there tends to be these volatility potholes where you get an August 5th where VIX could suddenly spike to 65 because there are just these liquidity vacuums. And so I would be wary of that going forward.
What does that mean for how you should be positioning into an earnings season that might be coinciding with some of those volatility potholes, Amy?
Yeah, I would say two things. The first is, you know, because how the meat is made matters, because the concentration risk is so high in these stocks, you can use that to your favor as well. So to give you an example, we had this week both Google and Tesla reporting, obviously large factors in the weight of the S&P. They also make up a large component of the XLC, the S&P Communications ETF. And if you actually look at that volatility spread between Google and XLC, that's actually at a 5-year high too. So meaning when you think about the dispersion in this market, so essentially that differential between the index level option prices and the single stock, you can often use the ETFs as a proxy when you think about these major weeks when a lot of the weight of a certain ETF will report as well.
To look through some of the comments we got, your colleague Lori Calvasina, I thought, flagged a really interesting one from Fifth Third, the bank, the local, the regional bank, saying you're seeing people make decisions, but it's not like a wild animal spirits risk-on sort of environment. Amy, what has been your read of earnings so far, both in what we've heard from companies and the market reaction to that?
Yeah, it's interesting because we were actually having this conversation about Netflix going into earnings. And if you just recall, you know, this was one that on the headlines, everything looked great. And it was a very muted, very underwhelming stock reaction. And when you had options pricing going into it, it was basically pricing about 2/3 of the 8-quarter median move. So one thing I would say is I think what's happening is you have all these historical moves that were sort of to some degree pandemic baked in, and those magnitudes look very high. Obviously, Netflix has, you know, they removed their subscriber numbers too, so that was unique to it. But I do think going forward, the animal spirits around earnings are, it's still wait and see. It's still a little bit early in terms of tariffs. We know there's going to be dribs and drabs, but even the management teams themselves are still waiting to hear what the final negotiations are. So it doesn't kind of surprise me that you're getting these underwhelming implied moves going into these earnings events when there's so much we don't know, Danny.
But Amy, so many people had said that this is an earnings season where the bar is really low. All these companies are going to be able to surprise to the upside, and then we'll see a rally. Why hasn't that played out? Because the bar had been low, or was it not low enough? What do you make of that sort of sentiment going into this season?
Yeah, I would say it's still early. We're really, financials obviously kicks off the beginning of earnings, but we haven't really had the meat in terms of the concentration. So to me, that narrative could change. I do think it's interesting when you look at this week and the week ahead. The pricing you have seen in terms of the sentiment of options has actually been relatively bearish. I'll give you a good example. Usually, at least in the past kind of 5 cycles for NVIDIA, it's been incredibly bullish. Essentially folks are buying call options into NVIDIA earnings. Granted, NVIDIA reports late, but you're not seeing that at all. You're seeing very bearish sentiment. That's been a pretty interesting shift. I think it speaks to this kind of reluctant rally aspect. And then the secondary aspect of the wait and see, they're still playing in, or I think we would have seen that exuberance already, and we haven't seen that priced into derivatives.
Amy, there was some hope that you'd get a real rotation earlier in this month where you saw momentum really sell off in favor of value. You note that petered out pretty quickly. Is it your expectation that just continues in terms of momentum, AI, tech, the kind of market leaders continuing to lead, at least for the next several months?
Yeah. Danny, I joke that's the Lori Calvasina indicator because she's the pro on small caps. So she hasn't turned bullish. I don't know why I would either. I would tell you that a lot of that, I have learned from working with Lori is the high sensitivity to rates. And since, when you look at the pricing, it kind of looks like a lot of the cuts that we potentially would have has been delayed, and that's just not good for the small cap story. So, you did see kind of this huge magnitude shift between momentum and value, but just as quickly that snapped back. I think if we can't get the rate story straight, we can't necessarily get the small cap story straight, and that is what's being priced right now into the factor rotation.
Amy, we really appreciate your time this morning. Wonderful to kick the week off with you. Amy Wu Silverman of RBC Capital Markets. Let's now get you some other top stories that are trending on the terminal this morning. Israel warns that it would move for the first time into a town in the heart of Gaza. It accused Hamas of stalling ceasefire talks. It had previously avoided the area for fear of harming hostages. The previous truce ended in May. A huge investment push from Germany's private sector. The country's top firms unveiled at least $116 billion worth of new projects to help lift the country out of stagnation. Deutsche Bank CEO Christian Savings spoke on this move on Bloomberg.
I think it's quite impressive what we have collected after a couple of months with over 600 billion of investments, 61 companies. And to be honest, I think more to come over the next months, but it shows what the sentiment is and that we have a chance.
And Microsoft's server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. Microsoft said it has released a new security patch to mitigate active attacks. And coming up, deal or no deal? Trade uncertainty rises as Brussels tools up for a no-deal scenario with Washington. We'll have the latest on your brief coming up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Less than 2 weeks until the tariff deadline set by the White House. At the same time, the European Union isn't as confident in the terms of a potential new deal. Envoys from the bloc are set to meet earlier this week to discuss how to deal with the U.S. if a deal cannot be reached. For more, we are joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, where exactly do negotiations stand between the EU and U.S. at this moment?
Well, the European Union's trade negotiating team delivered a pretty stark message to officials in Brussels on Friday, and that was that they saw that the U.S.'s negotiating position was hardening up. There wasn't much flexibility in the tariff rate, the reciprocal tariff rate that currently stands at a threat of 30%. The European Union wants that to be 10%, basically right at the baseline. And there was some other sectoral tariff relief that the Europeans are looking to get assurances on, and those aren't forthcoming as well. So we heard Commerce Secretary Lutnick say he's confident in the fact that they will get a deal, but he didn't say that deal was going to be great for Europe. He said that deal was going to be great for America. So the Europeans are increasingly looking at this like a scenario that's going to be out of balance, not in their favor, and they're looking to take what next steps they might go down in terms of retaliation against American exports.
What might those retaliations look like, Brendan?
Well, they have about $100 billion worth of U.S. products targeted, from Boeing airplanes to bourbon and some other, and soybeans and sort of, kind of all American type products that they could initially start off with. They also have something called an anti-coercion instrument, which is sort of the nuclear option. They could start going after U.S. tech companies. There's not a majority, an agreement on whether that should be used at this stage, but the calls for that instrument to be used are growing, and that's in the all-out transatlantic trade war scenario. We're definitely not there yet, but we only have 2 short weeks left to put this deal together before those tariffs kick in on August 1st.
2 short weeks, Brendan. Besides the EU, who else are we looking out for some potential movement ahead of that?
Well, we've reported that the South Koreans are in Washington this week. Japan still thinks that just off of its upper house elections is still thinking it can try to get a deal. Taiwan is also in the mix. India is still in play. All of these, especially the Asian countries, are looking to get their reciprocal tariff rate somewhere around 20%. Indonesia's got the 19%. So if all of Asia can get theirs to be around 20, that seems like a number that they could all live with. That wouldn't be too much disparity regionally. So between the Europeans, the Swiss are also have a deal on Trump's desk that hasn't been approved yet. So there are a number of these in the works that could come together between now and the end of the month.
And Brendan, thank you very much for that update. Bloomberg's Brendan Murray. Now, another sector we're keeping our eye on this morning, airlines, from earnings to other issues. On the issue side, Alaska Air has resumed flights after temporarily grounding its fleet late Sunday following an IT outage. We also learned that Delta had recently moved aggressively to avoid colliding with a B-52 jet. For more, we're joined by Bloomberg Managing Editor for Aviation and Space. It is Benedict Campbell. Benny, good morning to you. A lot of things going on here. I wonder when it comes to Alaska and Delta, if there's a commonality of things underpinning these potential mistakes that, of course, were avoided. Is there an issue of a lack of investment, or is something else going on here?
Well, that's usually the question that does come up, sort of what is the state of the industry, the software that is being used, what is the state of the personnel. We've heard quite a lot about this since the mid-air collision in January in Washington. Is the U.S. air traffic control properly staffed? Is there too much human error? Is there an issue with software? This is something that Alaska will have to take a very hard look at. These outages happen. Thankfully, they don't happen very often. But when they do happen, they sort of chip away at the public's sort of sense of safety. And that is obviously an important part of aviation. People want to feel good about getting on a plane. They want to feel safe. They want to feel that the technology, not just of the aircraft, but also everything that surrounds it, is up to snuff. And obviously, events like this with Alaska, yes, it was short-lived, but that doesn't help. The Delta issue, again, mid-air collisions or runway collisions, extremely rare, but when they do happen, they can be absolutely fatal. So this will be investigated quite aggressively, but two events that don't help sort of instill a faith of optimism in the industry.
Well, one place in this industry that definitely has optimism, Benny, you've been looking at their earnings all morning. It is Ryanair, the budget airline, seeing their profit more than double. What underscores that strong demand?
Well, there's a couple of things. Quite simply, people like to travel for the summer period, and Ryanair is in a good place. They have a huge network across Europe. They're expanding into favorable markets like Scandinavia, like Southern Europe and Spain and so on. So that's really helping them. They've got costs under control, but they're also benefiting to some degree from the missteps and the misfortunes, shall we say, of some of their rivals. Wizz Air, that's the Hungarian low-cost rival. They've had big issues with aircraft because of the engines that they had to take off and repair. EasyJet has had some issues with air traffic control. That's something that Ryanair has been able to sort of sidestep to a greater degree. So it's both the product, but also sort of what's going on in the broader industry. They also have the advantage of Boeing aircraft coming back into their system at a greater clip. They had real issues about 6 months to a year ago where there were massive delays on Boeing aircraft. That seems to be behind them now. They are getting the kit that they need. They are getting the lift, and this is right ahead of the crucial summer period. And you see it in the stock price. A lot of analysts are upgrading their forecasts, saying this is early in the year for them in the fiscal year. So there's upside here, and you can see it in the stock. It was up 10% at one point this morning.
Yeah, now up just under 7%. Benny, thank you so much for that. That is Bloomberg's Benedict Campbell. Now, it might be a different story for Stellantis, the car maker reporting a brutal first half, a near $3 billion net loss, restructuring expenses, waning sales, U.S. tariffs, all impacting a role, or playing a role, rather, in the results. For more, joining us is Bloomberg's Albertina Torsoli. Albertina, I mean, these are really some ugly numbers. What were driving them?
There's various things at play here. There's a lot of focus on U.S. tariffs, and clearly, President Trump's tariffs or the various announcements in the first part of the year of what he would and wouldn't do on that front didn't help. The company announced today, and this was a preliminary announcement, a surprise announcement, because their full-fledged first-half earnings are due on July 29. The tariff impact was a net impact of 300 million euros, so about $350 million. But there's more to the story. There's a new CEO to the story. There's been a very difficult 2024 for the company, and there are tough decisions that are being made, investments that are being, moved around, reassigned, and a pretty big move from the full-fledged push into electric vehicles that was, what defined the era of the previous CEO, Carlos Tavares, into other areas, notably hybrid vehicles, closure of plans, decision to drop investments in hydrogen. So this is really the first step that the new CEO, Antonio Filosa, is making to reset expectations. Analysts are calling it a bit of kitchen sinking, but also really reshifting the priorities here at the company at a very difficult time for the industry.
That's for certain. Shares down 2%. Albertina, thank you so much. Albertina Torsoli there. Coming up, we're going to get you set up for your week ahead. That includes some big Mag 7 earnings on deck. That's coming up next on your trading diary. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Let's get you set up for your trading week. Big tech earnings will be kicking off Tesla and Alphabet. They both will be reporting on Wednesday. Then we'll get Intel. They report on Thursday. Also on Thursday, we'll get U.S. PMIs and jobless claims data. Now, in the meantime, let's look at some of the stocks on the move pre-market. Block, one of them, a rally underway. It's going to be joining the S&P 500, up 9.6%, getting some of that passive flow. It will be replacing Hess after Chevron finally successfully bought the company. Sarepta, that's been cut to neutral by Mizuho. Price target is at $14, trading just below that, down 1.7%. It has also refuted an FDA request to pull its gene therapy. Finally, Tesla, that is leading The Mag 7 stocks higher this morning, up just under 1.5%. It will be reporting earnings later this week, as you mentioned, on Wednesday. A big earnings week, 20% of this market reporting based on market cap. All right, a quick look at your bond market because a rally is underway. After some declines, some steepening all last week, that reverses somewhat this morning. 30-year yield down nearly 4 basis points. All right, that's it for your brief. Surveillance takes things from here. You're watching Bloomberg.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
It is kind of a murky data picture.
We need to be careful of some of these cracks in inflation data.
There are certainly signs that the labor market is more fragile than it looks.
What we're really waiting for is this pass-through of inflationary impact.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, just short of all-time highs. Investors looking ahead to Q2 earnings from the Mag 7's Tesla and Alphabet. Fed officials enter the blackout period, leaving the president waiting for rate cuts as the European Union is facing down a trade deadline, hoping for the best and preparing for the worst.
It sets up a real question of how do different regions respond to hardening rhetoric coming out of the Trump administration as we get closer to the latest deadline of August 1st, especially given the fact that there are political considerations at home, and we'll talk about that with Japan in particular. But with the European Union, a big question here, do they go nuclear and really go to the option of retaliation with measures such as taxing tech giants from the United States in response to levels that are not plausible for them, like 15 to 20% tariffs?
Or will this White House just take the win? Take the win. The EU, based on our reporting, is prepared to accept an unbalanced trade agreement here, accept that 10% tariff and walk away. But it seems like, based on what we're hearing over in Europe, that the Americans are pushing for more and pushing for more.
And what you have right now is actually no movement. A ton of activity. Once again, you're going to have negotiators likely in Washington, D.C. Yesterday, Commerce Secretary Howard Lutnick was on Face the Nation and said, I just got off the phone with them. And when he said, when he was asked about, what if they go after Boeing? What if they go after Kentucky bourbon? What if they go after soybeans in Louisiana, the home state of Speaker Mike Johnson? He says, they're not going to do it. They're not going to do it. It is this moment that the U.S. is trying to extract whatever they can with 11 days to go.
You say no movement in trade talks, no movement in this market, very close to all-time highs. Deutsche Bank this morning, we expect another leg up in equities. This came from Mike Wilson of Morgan Stanley. What did he say? We think dips are meant to be bought. You're seeing that on repeat across Wall Street.
Which has led to this FOMO type of environment, a fear of missing out, which has legs of its own when you start having people pile in just because they're worried about not getting the sort of gains that you potentially could get. I just wonder if people are getting a little bit too excited about looking past the noise that we have seen throughout the year in terms of policy shifting under the hood and just looking to this industrial revolution tied to investing in new tech. And that, I think, is one of the things that's really driving a lot of optimism about CapEx, et cetera, even amid all of the headlines that we talk about every day that exhaust us.
The data has been okay. Yes. Headline data, CPI, PPI has been okay. We can talk about the details through the program. Retail sales and jobless claims last week have been okay. Corporate America continues to say all the right things. And there's still a strong bias of this Federal Reserve to cut interest rates. Even with that strong bias to cut interest rates, the tension continues to build between Chairman Powell and the President of the United States. And over the weekend, throw in the Treasury Secretary, Scott Bessent.
President over the weekend came out with a Truth Social post following this Wall Street Journal article that said Treasury Secretary Scott Bessent laid out his argument on why the president should not even consider firing Fed Chair Jay Powell. And this is what Trump has to say, quote, nobody had to explain that to me. I know better than anyone what's good for the market. So basically, it's almost an acknowledgement from this president that he knows the negative impact on the market and the economy if he was to fire Jay Powell. So then the question is, why does he continue to bring it up every single day?
Is Bessent out of the race now, based on those comments?
Bessent's out of the race just simply because there's no one who can replace Scott Bessent, who's currently in Japan trying to smooth over whatever kind of mess is going to come from that election. And meanwhile, you have a situation where ultimately he is the only adult in the room. A lot of people think. I don't want to get there, but I just went there. I mean, there's a real question here about whether there will be credibility for the next appointee to be the chair of the Federal Reserve, given all of the rhetoric and given all of the political speculation, regardless who it is.
Live from New York, welcome to the program. Looking ahead to a quiet week, we hope. At least the schedule's light. Equity futures on the S&P 500, positive by about 0.25%. Coming up this hour, we'll catch up with Lori Calvasina of RBC, with stocks trading very close to all-time highs. Patrick McHenry, as the U.S. trade team hardens its stance, and Angelo Zeno looking ahead to big tech earnings. We begin this hour with stocks trading near record highs ahead of a big week for tech earnings. Lori Calvasina of RBC writing, we're lifting our year-end price target to 62.50. We reviewed what we've learned from the early reporters, which makes us think it's too early to start worrying about tariff impacts. Lori joins us now for more. Lori, good morning.
Good morning.
I was going to characterize this as a reluctant raise from you and the team. How would you describe things?
Look, I just think at a certain point you realize investors are thinking a little bit differently than you are, and you adjust and move on. And that's what we did with our target raise last week. I was basically living on the road in June talking to investors all over the country, and I heard time and time again, people felt like they paid the price for whatever economic wobbles we were going to have, whatever inflation, kind of challenges we were going to have back in April, and it was time to move on to 2026. And I'll tell you, the first few times I heard that, my jaw dropped. But as you start hearing it from more and more people, of different backgrounds, you realize you've got to bake that into your thinking. And so that's essentially what we did. And one of the things we did was we removed sort of our policy assumption. We had been telling people, we had been baking in sort of a business-friendly backdrop at the beginning of the year. We weren't baking in sort of 2018 type scenarios, to our more recent ones. We didn't feel like that was appropriate anymore. So we took that out, and we put in a test that evaluated how stocks perform ahead of the economic environment people think we're going to get next year. And the result of the math is that it pushed the numbers up.
It's a big question, I think, for all of us around the table. How do you price in 26 without resolving policy issues in 25?
Well, that's a great question, and I really pushed hard on that. And, I do think there is an issue. If you go back to April 8th, and we saw that growth scare low, that 18.9%, that was baking in some pretty onerous stuff at that moment in time. What we've heard from corporate America since then, I would say, is not off to the races by any stretch of the imagination, the same way the stock market, has been kind of off to the races. But I do think corporates are doing their best to manage through this issue. We need a lot more detail from them, especially on inventories going forward. But at this point, if I think back really to the first trade war back in 2018, I mean, companies have been tested time and time again, and they're taking a lot of pride in their ability to manage through. And so we have continued to hear that from corporate America. Now, I'll warn you, John, it's not all easy. I think this is going to be somewhat messy in this reporting season because not everyone is going to have that ability to execute. And some of the early reporters did not, and they got punished for it in terms of their stock prices. But I do think generally, if you're kind of zooming out, the S&P companies are really trying to manage through this best they can.
You say you removed your attempt to quantify what policy can mean for the market. So what are you left with when you look at Washington? Do you just think it's so uncertain that you can absolutely ignore it? What's the risk in that?
Well, look, I think, before we sort of had the typical kind of business-friendly environment, we had something more onerous before. The answer is something in between, and I'm not quite sure what number you put on that in between, but I do think, that there are different, what's the right word, crosswinds. Right, you've got some tailwinds, you've got some headwinds, and as investors, we're going to be battling that out any given day in the stock price. But we do know that investors are trying to take this long-term issue. And I'll tell you, Anne-Marie, the other thing that sort of cemented this in my head, and I think I was talking with someone on Bloomberg, it may have been all of you around this time, but looking at the Middle East situation, I mean, I didn't think that was going to necessarily tank the market, but I thought that we might have at least gotten a 5% drawdown. And what I really heard from investors, on some calls we did, was really a desire to look longer term on that issue as well.
When it comes to how Trump right now views the market, over the weekend he was talking about no one needs to explain anything to him, especially when it comes to the firing of Jay Powell. He went on to say, if it weren't for me, the market wouldn't be at record highs right now. Well, if it weren't for him, would the markets actually be higher? Because the market is still, at least some investors, likely pricing in the question of an independent Fed, what is going on with tariffs. The only real certainty is the one big beautiful bill and deregulation.
Right, and I think deregulation is something, if we just kind of take each of those individually, I think deregulation is obviously a positive for financials. Our analysts have also pegged it as a positive for energy, though there also are some offsetting issues with the lower oil price, which has been a goal of this administration as well. And so, that impacts profitability. It makes it somewhat complicated. But generally what I've told people is I have a hard time knowing how to model deregulation in terms of what dollar value that's worth to earnings. It feels like a tailwind, but a bit of a vague one to me. The one big beautiful bill, I mean, if we think about that, and Lisa, your comments on CapEx earlier, I don't know that people are necessarily, in my conversations at least, I think the AI bullishness is there. I don't think that has changed, or if you were a skeptic, that hasn't changed either. But I'm hearing a lot about bonus depreciation and how that might spur plain old-fashioned CapEx. I'm watching out for that. I've gotten mixed feedback on that from my analysts, so I think we keep an eye on that as well. If you think, though, Anne-Marie, and I think this is sort of one great lens to look at this through, if you look at consensus GDP forecasts, and that's a big driver of revenue on earnings, we're stuck in the mid-% range, whether you're looking at RBC views or consensus views. Back at the beginning of the year, that was at 2%. So that's just not back to where it was. And inflation numbers are generally up as well, which weighs on your multiples. So I do think that we have endured some pressures here. And frankly, I got some questions even before this target raise. Why aren't you just going back to your 6,600 back in January? And I've been very adamant with people, this is not the same world that we were in back in January.
I'm so glad you could make it in, because I know that around this time you typically have your head buried in all the earnings calls and just parsing through all of the transcripts. And what we're hearing from companies doesn't match what we're feeling in markets, something you pointed out. Yeah. Does that matter, or is that just a whole bunch of corporate executives sandbagging us until next quarter?
So I think it matters in the sense that if I look at the soft data, and we always like the Duke CFO survey because it comes out right before earnings and it kind of gives us a good sense of the tone ahead of things. When we look at that, when we look at a couple of these other C-suite surveys that have come out recently, they haven't seen the same inflection that we saw in things like NFIB or the Conference Board Consumer Survey or the University of Michigan survey. So the stock market's been queuing off those kind of consumer small business sentiment inflections. But I think it's important to note that even in the data, if you're not just taking my word for it, right, in terms of reading all these things, even in those soft data prints, we haven't seen that same inflection. And I don't think investors realize that.
Do you feel like we're all just exhausted about being bearish and being wrong, and so you're hesitant to really have anything that's below where we're currently at?
I think that you have to listen to the market and you have to listen to kind of what people are telling you they're doing in terms of making decisions. And it was funny, I was doing a dinner with Elsa Linos, our FX strategist. I forget exactly what point this was. I think it was late June. And she sort of made the comment about, what can you forecast with any reasonable degree of confidence? And it seems like there's sort of, at the time, this dinner we were talking at, kind of general uncertainty. Can we forecast the next 3 months? That didn't seem to be like a high confidence level. But longer term, people tended to have more conviction on. So if you get these wobbles in the market and you have a stronger longer term view than shorter term view, why not go ahead and trade on that? That actually makes sense to me.
We was an interesting word then. Are we all getting exhausted of being too bearish?
We are tired from this debate at home every night. Yes, exactly. I think, look, there is a feeling that if you start worrying about certain things over and over again and people just start slamming you for it and you're wrong, you start to wonder, should I worry about anything?
That's the drawing, the sucking in sound, right?
That's the
that's
FOMO. That's where we're at right now.
Laurie, it's good to see you.
Good to see you too.
Thanks for being here. Laurie Calvasino of RBC. Looking ahead to lots of earnings over the next week. It starts on Wednesday with Tesla and Alphabet. The following Wednesday, we'll hear from Microsoft and Meta. Then next Thursday, you'll hear from Amazon and Apple. Then, as Lisa said just last week, in 10 years' time, on August 27th, you'll hear from NVIDIA. They've got to fix that, haven't they?
I mean, come on. They're like the key player here to give us a sense of AI investment. And they don't come until we basically started in Q3 earnings season. So at a certain point, you have to wonder, okay, are they really just trying to be different? Do they need to? Jensen Huang, come on, be the rock star, put on your yellow leather jacket and come out just a couple weeks
By
earlier.
August 27th, we'll be pricing in 2028, won't we, in equity markets? Equity futures on the S&P, positive here by 1/3%. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit in October. The South China Morning Post cites sources saying Trump could make a stop in China on his way to the summit in South Korea, or they can meet on the sidelines. Sources telling us here at Bloomberg that Trump has been dialing down his aggressive tone with China in hopes of securing a meeting and a trade deal. Meanwhile, Stellantis shares are falling in European trading nearly 1.7%. The automaker reported a $2.7 billion net loss in the first half due to restructuring expenses, weak sales, and the impact of U.S. tariffs. Analysts had expected a small profit. And because of the trade uncertainty, the company has not yet issued financial guidance for this year. And Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. In response, Microsoft said it released a new security patch to mitigate active attacks. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes from now. Up next on the program, pushing for a deal.
Look, the president and the European Union, these are the two biggest trading partners in the world talking to each other. We'll get a deal done. I am confident we'll get a deal done.
Up next on the program, the former Republican Congressman Patrick McHenry, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bramo said it. Julian Emanuel of Evercore agrees. FOMO has begun. In his note over the weekend, reflected by a lot of the research on Wall Street this morning, we think dips are meant to be bought. Mike Wilson of Morgan Stanley looking for another leg higher over at Deutsche Bank in this equity market. Here's your leg higher. Equity futures on the S&P, firmer by 1/3 on the NASDAQ, up 1/3 on the Russell. The small caps up by 0.6. Under surveillance this morning, pushing for a deal.
Look, the president and the European Union, these are the 2 biggest trading partners in the world talking to each other. We'll get a deal done. I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Here's the latest this morning. The Commerce Secretary Howard Lutnick hopeful the US can make a trade deal with the EU before the August 1st deadline. Sources telling us here at Bloomberg that EU envoys are preparing to meet as early as this week to plan for a possible no-deal scenario. Joining us now is Bloomberg's Akela Gardner. Akela, welcome to the program. Let's just focus on this relationship between the United States and Europe. What's the state of play?
Well, the EU was one of several countries that was surprised to receive these letters from President Trump, despite the fact that they've been in the midst of negotiations for weeks, if not months here. The president wrote to the EU saying that they will face a 30% tariff. And now we're 2 weeks away from that August 1st deadline. And these 2 counterparts, this bloc, which includes, of course, many countries that have different perspectives and making this a lot more complicated, frankly, for the bloc, and the U.S. are going to continue to meet going into this week. But some of the things that the EU is looking for is really restrictions on certain sectors like steel, aluminum, aviation, some manufacturing equipment, medical devices. But before this letter, they had assumed that potentially that they could see a 10% tariff. This is a much higher tariff number that we saw with the president's letter. And this is something that major trading partners are sort of having to expect now. They're going to expect these unbalanced agreements. Some countries have 0% tariffs, the U.S. much higher, and this potentially could be the case, and this is the scenario that the EU is gearing up for. And they have said from the beginning that they would retaliate if the U.S. puts tariffs that they are not comfortable with, and that is something that the U.S. is certainly going to have to expect, but it comes with a lot of risk, because we saw with China that the U.S. will retaliate. At one point, of course, China's tariffs were as high as 100%.
Akela, as we know, these are self-imposed deadlines, and these deadlines can change. How seriously are trading partners taking that August 1st deadline?
Well, Commerce Secretary Howard Lutnick said yesterday that this is a hard deadline. He says that they're going to continue to take calls. They'll be open to negotiate after that August 1st deadline. But he says tariffs will be imposed on that day. And so if you take this Commerce Secretary at his word, that is the deadline. But of course, we've seen many times in the past that deadline has moved.
Akela Gardner of Bloomberg down in Washington. Akela, thank you. How seriously is this market taking this August 1st deadline?
Scott Bessent told us not to care about at least the one with regards to China, saying that August 12th deadline, we're telling markets, don't actually think about that so much. And we've seen it push back again. At the same time, does the specter of the taco threat kind of hang over President Trump? He wants to show that he's serious about his deadlines. And this is the reason why the market's just numb and going on vacation.
Well, if you are negotiating, you have to stick to your guns in order to get the most out of the negotiation. But what I would say is that what I've heard from trading partners, they say if they are at the tail end of these talks, They are basically being told by this White House, stay in good faith and we will let you extend, which basically means that every deadline that this White House comes out with is fluid.
Joining us now to extend the conversation, the former Republican Congressman Patrick McHenry, also the former chair of the House Financial Services Committee. Patrick, welcome to the program, sir. Let's just talk about these deadlines and the posture of the White House right now, negotiating with trade partners all around the world. How seriously should we take that August 1 deadline?
I think it's been said already. I mean, two things can be true at once. The deadline is serious. It is meaningful. The market should cue to this. Trading partners should cue to this. But this White House has maximum leeway to extend. And each trading partner is in a unique position with the United States, and so much of that has to do with the individual tone of the negotiations that we are not privy to. It's done behind closed doors. Is a real question about the notion of goodwill, and the notion of goodwill is a judgment call. And so this complicates really what we're going to see over the next 30, 60, 90 days. And each one of the trading partners are in such a significantly different position in how those conversations have gone behind closed doors.
Well, when it comes to an ally like the European Union, you were in Congress alongside Speaker McCarthy when there was a lot of emphasis on the China Select Committee. Is there damage being done with all this job voting with allies like the European Union, like Japan, even though most Republicans want to see a firm stance when it comes to one country only, and that's China?
Well, I think you're seeing that President Trump has significant leeway among Republican legislators on Capitol Hill. Look, the Republican Party I got elected with 20 years ago was a free trading party. That has changed significantly over this time. This president has maximum authority and leverage with Republican legislators, and that's why you're seeing him get this long rope in negotiating these deals.
If the European Union, though, does come back and retaliate with politically sensitive goods like soybeans from Speaker Mike Johnson's Louisiana, will then we potentially see some Republicans dial the White House and say, look, we have some concerns about this, especially when it comes to the agricultural sector?
Well, they tried this. China tried this in 2018, 2019. This playbook's already been done. I think what these trading partners have done is dial this up significantly and trying to be very specific about the implications, well, the impact that they would have on individual states and districts. But I think there's a lot of pain that legislators are willing to take before they go against President Trump. So I don't think it's going to work out for these trading partners to do it. I think it's going to be far better to cue to what Secretary Bessent has said publicly, what Secretary Letnick has said publicly, is be of goodwill and you'll get good treatment. And I think that's what we need to listen to more acutely than these retaliatory measures that other nation states are listing out or making the threats that they will take these actions.
Patrick, you alluded to something there that I think is really up for debate among a lot of different publications and prognosticators, which is unity in the Republican Party. And you said that it does seem like Republicans will be willing to take quite a bit of pain before really speaking out against what President Trump is doing on trade. Do you think that there are signs of cracks in that unity in the Republican Party that have been growing over the past few weeks that are different and new and potentially have ramifications for some of these policy implications?
The beatings will continue until morale improves. No, I don't think there are significant cracks. I think Capitol Hill is much more chaotic right now to produce legislation than it's been in many years. But the results are there. The president got the crypto bill in the style and form he wanted, signed that on Friday. He had the one big, beautiful bill. He signed it on July 4th. He said he wanted to sign it on July 4th. He got to sign it on the 4th of July. I think he's getting what he wants out of policymakers on Capitol Hill. But in the fall, we have not only tariffs and trade to deal with, but we have a potential government shutdown. And negotiating through that is going to be quite a significant challenge for the administration and for congressional Democrats who have the ability to block government funding.
Patrick, appreciate your time, sir. We'll catch up again soon. The former Republican congressman there, Patrick McHenry. Republicans united on one issue, seemingly. This from Semaphore this morning. The Trump administration wants to visit the Federal Reserve this week to review its $2.5 billion renovation. Senate Banking Chair Tim Scott in talks to attend as well.
Well, is this the new way to sort of curry favor with the president to try to gang up on the Fed chair, especially if you have any interest in being Fed chair yourself or even, potentially just win political points? Why is this what we're talking about? Honestly, I just keep thinking about this. The Journal article, yes, this was something that President Trump dismissed, but realistically, the arguments that Scott Bessent allegedly made have resonance. They're going to cut rates, and what are you going to actually accomplish if you do kick him out?
The beatings continue. Coming up on the program, Angelo Zeno of CFRA as tech earnings kick off this week. Plus, we'll catch up with Danny Berger with your morning movers as Stellantis stalls. Live from New York City, you're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator and pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Equity markets doing okay. Futures positive by 0.25% on the S&P 500. On the Nasdaq, up again this morning by 1/3%. Banner Buwaita of UBS with some pushback. It's the wrong reaction to look past these tariffs and move on. When the inflation impact comes through, hits real disposable income, that's when I think markets will begin to see this. There isn't much of it, but there's some pushback out there.
And it's coming at a time of valuations that are resonant of levels and types of speed that we haven't seen since 1999. We haven't seen it in the data yet. And a lot of people expected to see it by now. And because they haven't seen it by now, they're dismissing it as fiction. And that, I think, is one of the reasons why we have FOMO once again.
Well, we see it in the earnings. More earnings still to come this week. On Wednesday from Tesla and from Alphabet. We'll talk about that in just a moment. 3 hours away from the opening bell. Let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. We have a new entrance to the S&P 500, and that is Jack Dorsey's tech firm Block. A lot of passive money goes into stocks that are added into the index. You can see those shares up 9% in the pre-market. It will be replacing Hess, which finally, after 20 months of drama, was acquired by Chevron. Elsewhere, a little bit of sell-side action. Morgan Stanley upgrading both Etsy and Pinterest together this morning. Both those shares rallying 4.3% for Pinterest, 3.5% just thereabouts for Etsy, saying that valuations for both of them look attractive and trends are favorable for them for this earnings season, and that should be a catalyst for shares to go even higher. Now, the same can't be said for Stellantis in terms of good earnings. Was this the kitchen sink moment for the new CEO, booking a first half loss of nearly $3 billion, to be specific 2.7. Analysts had expected at least a small profit. That's not what we got. We got a glimpse into what the new CEO has to deal with going forward, everything from tariffs to expensive cancellations of some of their EV programs and lesser demand there. So those ADRs down 1.6%, John.
Too many brands, not enough focus. Danny, thank you. More from Danny in the next hour. Every single time we talk to the company, we had that conversation. Everything's on the table. Everything's still on the table.
Well, I was driving this weekend. I saw a Dodge. Who buys Dodge anymore? And I was thinking to myself, this is part of the problem. Why are we saying that when we see a Dodge, even though we're not saying that even when we see any kind of Kia, particularly Tellurides?
That one guy who you saw, basically.
Was that one guy, but it was really noteworthy. It was more noteworthy than a Tesla or a Camaro or anything else. It was just notable.
Matt Miller as well, right? I think has a Dodge, doesn't he?
Does he?
I think so. I think I'll check in with Matt later. I'm sure he does.
Really?
Equity futures this morning then positive by 0.25%, very close to all-time highs. On our radar this morning, President Donald Trump disputing a Wall Street Journal report claiming Treasury Secretary Scott Bessent told him not to fire Fed Chair Jay Powell. Trump posting on Truth Social, quote, "People don't explain to me, I explain to them."
Noise versus signal. That's what I keep coming back to. Why is he rebutting this? Is it a point of pride? Nobody can tell me what to do. Nobody has to explain anything to me. I'm the smartest guy in the room. Or is this to keep the speculation ongoing to try to jawbone the Fed into taking some sort of position? That's the reason why the story isn't going away. The markets, though, have moved on, and that's what we're seeing today.
And when it comes to what Trump is talking about in this Wall Street Journal piece that he says is flat out wrong, no one needs to explain to him, is Scott Bessent laid out a number of issues impacting the economy, impacting the markets, the fact that they might just be cutting rates anyway, so you're going to get what you want, and also the legal hurdles. One thing, though, the president potentially wants to do is he wants a scapegoat for the fact that there was a poll over the weekend that about 70% of Americans do not think they are focused enough on inflation and bringing affordability back into place.
This market has moved on, to Lisa's point, moved on to looking ahead to 2026, according to Laurie Calvasina of RBC. How can you look to 26 without resolving the policy issues of 2025? Here's one right here. The EU is heading into another week of trade negotiations with the US, but gearing up for the worst. Sources telling us here at Bloomberg, the bloc is preparing a retaliation plan to respond to a possible no-deal scenario.
And what you have right now in Europe is a lot of mixed feelings. You have France, which basically wants to say, we're going to go as hard as using this anti-coercion measure and do some of the biggest retaliatory measures we can, put them on the table. Others, according to our reporting, are prepared to stomach an unbalanced agreement just so that they can get agreement in place, stop the uncertainty, and get numbers in place. What the U.S. is looking at right now is potentially even higher than 10% and less carve-outs. Can Europe stomach that? That's the big question for the next 11 days.
The win is available to the U.S. and to the White House if they want to take it. Europe is ready to take something, accept something they weren't willing to accept only a few months ago. Are they going to take it or not?
You said that before, and I picked up on that. I thought that was a really astute point, especially because Howard Lutnick is saying they just want other nations to open up trade to the United States. Is that truly the goal? Well, the goalposts keep moving, and that's one reason why Europe is preparing for other outcomes. There's also the fact that local elections matter for international policies, and we keep seeing that, and that's very relevant for Europe and a number of other regions.
Well, let's talk about one of those regions. Let's talk about one of those countries, Japan. The Japanese Prime Minister, Shigeru Ishiba, is vowing to stay on after his coalition fell 3 seats short of an upper house majority, marking the first time since 1955 that a leader from the LDP will govern without a majority in at least one legislative body.
And it comes 11 days before that August 1st deadline that they're supposed to come to some sort of trade agreement, with Scott Bessent heading over to Japan right now to discuss it with a leader that's effectively been neutered. Right now, markets are breathing a sigh of relief that the worst case scenario didn't come to pass, where he was forced to step down. But you start talking about fiscal policy, you start talking about negotiations when it comes to trade deals, you start talking about the sea change that is inflation, and how much that has caused incumbent leaders to be kicked out of office again and again.
Policy gridlock used to be a good thing for markets. Some of the issues that these countries face now, is policy gridlock still a good thing for markets?
It's a tricky question, given the fact that the world is moving on. Policy gridlock is sort of a relic of a time that was more stable than the one that we're facing off with now. Right now, Japan is facing off a fiscal crisis, and if they start cutting taxes, watch out for those bond yields to surge.
That's the situation in Japan this morning. Let's turn back to tech. Tesla, Alphabet, kicking off big tech earnings this week. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome to the program. Kicking off Mag 7 earnings. What are you and the team looking for later in the week?
Well, we heard in the last 90 days that the GPUs are melting a few times. So, clearly that beat and raise is very important from all the cloud hyperscalers, especially Microsoft. I mean, clearly they are the biggest beneficiaries with OpenAI's models doing really well. At the same time, the CapEx increase. So our framework now is, if the cloud revenue grows by, let's say, mid 30%, then they will raise their CapEx by a similar amount, 30 to 35%. But from this point on, you will see a matching of revenue growth with CapEx growth. And that's the framework we apply to all of the hyperscalers except Meta, which doesn't have a cloud business. But you want to see that inferencing show up in the cloud revenue. And that's where I think Microsoft will do really well.
Mandeep, when it comes to Alphabet, there's a word that pops up all the time: existential risk. And what that company is facing at the moment, it's down on the year, it's had a big rally off the low. I think we're on an 8-day winning streak going into earnings at the moment. What kind of risk does that company face? And are they behaving in the same way that, say, Meta is and Mark Zuckerberg, which is behaving as if they face an existential risk?
Well, look at the numbers. So ChatGPT is now doing 1 billion queries a day. Compare that to an Alphabet, Google doing about 14 to 15 billion queries a day. So clearly, ChatGPT has made inroads in terms of the search query volume, but we know ChatGPT doesn't have an ad model. So from that perspective, Google still has a lot of levers to pull on the search side, YouTube side, and that will show up in the ad pricing this quarter, and you will see them at least post inline numbers on search. And all other segments should outperform, whether it's YouTube or Google Cloud or Waymo for that matter. But clearly, everyone is fixated on search because that's what drives the bulk of the free cash flow.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. No doubt we'll catch up with you on Wednesday and beyond. Angelo Zeno of CFRA has a buy rating on shares of Alphabet, a 210 price target. Angelo, welcome to the program. That ad model at Alphabet, how insulated is it right now?
Yes, thanks for having me, John. As far as kind of the ad model is concerned, I mean, listen, I think they're doing a lot of great things as far as what's going on across search as well as YouTube, integrating AI across the ecosystem. You've got AI mode ramping here on search, AI overviews. So overall, I think the monetization potential looks pretty good as far as their ad-based businesses and AI integrating across that ecosystem. Clearly there is a risk as we kind of go on here over the next couple of years. Eventually, OpenAI and others out there will probably have some sort of ad-supported models. And that is, clearly a risk here for Alphabet. So sitting here today, I mean, we do think their Google's ad-supported businesses probably grow around in line with the broader digital ad market. Let's call it high single-digit growth. But, ultimately, as we kind of go into some of these forward-looking years, 2026, 2027, we're looking at the growth pace of, something like search to grow at about half the pace of the digital ad market. just because you're going to have some, increasing competitive pressures out there.
Angelo, are we underestimating the speed of the adoption of OpenAI, of ChatGPT, and some of these algorithmic models that some people find superior to the classic search model? I mean, I was listening to John and Mandeep talking, and I'm thinking to myself, I've known so many people over the past 6 months that have utterly transformed their workflow because of ChatGPT. Is the time frame a little bit faster, potentially, than what we're talking about?
I mean, potentially. I mean, I guess we'll see here. I mean, ultimately, people are doing search in a different way than they have historically. And but when we think about just overall what Alphabet has, across their ecosystem as well, I don't think it should be underestimated. I think Gemini is an enormously powerful tool. I mean, I'm personally a power user of Gemini. I do love the fact that it's across their entire ecosystem out there. There is an advantage out there to that. I think that Alphabet's getting extremely smart with Gemini. So, I don't think you can completely dismiss Alphabet specifically and what they're doing across the AI ecosystem. Not to mention their infrastructure, I think, is better than just about anyone else's out there. But again, that being said, I mean, maybe to your point with what OpenAI is doing with ChatGPT and others out there as well, there are going to be more options out there in the market. And that is something that I think, as an analyst, you can't underestimate, and you do have to factor that into your future assumptions. But we do expect, ultimately their ad-supported businesses to continue to grow. It's just not going to be at the pace that, maybe you're seeing from, the market here over time because of the broadening out and greater competitive pressures.
A couple of months ago, there was a skepticism on Wall Street about the amount of money that hyperscalers were spending on R&D, on CapEx, and there was this question of, are they overspending? Meta had said, we can't spend enough. Do you think this season you're going to see a rewarding by investors of companies that increase their CapEx spend dramatically, or do you think that that's going to be treated with the same skepticism as a couple of months ago?
Well, I think what you're actually going to see this earnings season, I think you're going to see CapEx spending plans sustained and not increased. We actually saw Meta increase it last earnings season as far as their 2025 CapEx guidance. I think, Microsoft has actually done a pretty good job here over the last couple of quarters, essentially kind of flatlining the CapEx number, leveling it out. This is their year end, so we'll kind of see what type of guidance and outlook they decide to provide here for investors here over the next year. But I actually think, for the most part, you're going to actually see more favorable return ROI metrics across kind of some of these cloud providers because of how they're spending on the CapEx side of things. They are shifting more towards the server side of things here over the next couple of quarters and years. And clearly the growth pace is, starting to kind of decelerate and level out a little bit here. So I think kind of the return on investments are going to see considerable improvement here, not only over the next couple of months, but over the next couple of years. And I think investors will reward that. Maybe to your point, I think the other important point here or item to look out for here this earnings season is something along the lines or looking at the OpEx side of things, something that these companies have really been holding kind of leveling out here over the last couple of years. Actually, if you look at employee headcount, whether it be from Google, Microsoft announcing recently some of their headcount reductions, essentially down over the last kind of 2 to 3 years, flat to down. And I think it'll be interesting to kind of see how all these companies comment relative to what we've seen here from Zuckerberg over the last couple of weeks and months. I think that's going to be really an important storyline as well.
Angelo, appreciate it. Angelo Zena there of CFRA. Big focus for us here at Bloomberg, doing more with less as some of the world's biggest companies.
At least fewer people, right? But is it less investment? And that's sort of the question. Meta's been a forefront leader in terms of cutting staff, but then increasing their CapEx. Is that repeated by others?
What happened to the year of efficiency? Now he's like going around like Stevie Cohen, collecting superstars.
Well, if you could invest in the Mets, I'd be okay with it. I do think, though, that going forward, there is a question of where you're investing. He tried Meta, that didn't work, so now you've got to invest in the physical infrastructure of the world and how that relates to technology, and that's where his mind really clearly is at.
A big week coming up for tech earnings. Equity futures right now in the S&P positive by 0.25% with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Israel has warned it will move into a town in the heart of the Gaza Strip for the first time. It had been avoiding this town for fear of harming hostages. Hamas, meanwhile, says almost 1,000 Palestinians have died while they were waiting for aid. Meanwhile, shares of Domino's Pizza are rising 5% in the pre-market. The company's second quarter revenue coming in at $1.15 billion, slightly above the average analyst estimates, with same-store sales growth in the U.S. driving revenue higher. Meanwhile, EPS came in lower than expected at $3.81. And Blackstone has pulled out of a bid for a stake in TikTok's U.S. operations. Sources telling us here at Bloomberg the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz, and General Atlantic. TikTok is facing a September deadline to find an American owner or be banned in the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. The rolling 90-day deadline. TikTok extension after TikTok extension.
Absolutely. It just keeps getting kicked down the road when it comes to TikTok. It's like, are they ever going to come to an agreement? But potentially this is part of the grand bargain. So maybe it'll come to an agreement when Xi Jinping and Trump finally sit down.
The latest deadline is September. Up next on the program, the race to replace Chair Powell. Is it a position you would like?
If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
That conversation up next with Skylar Montgomery-Koenig of Barclays from New York. This is Bloomberg.
You missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's a nice, quiet summer Monday.
Don't say that.
What's wrong with that?
It's just that we're so used to, this hyper-stimulation that you're trying to sort of dare the market into having some.
You're jinxing it. The second you say it's quiet.
I'm trying to do anything. It's a nice, quiet summer Monday.
You know what you're trying to
Hopefully we get a nice,
You know what you've done.
summer week.
You're trying to poke the bear.
Taking Friday off now. Just put that in the diary.
You are?
I am.
I also
Equity
asked
futures
for
on the
Friday
S&P look like this. Futures are positive by 0.25%, up a third on the Nasdaq 100. Under surveillance this morning is the race to replace Chairman Powell.
Is it a position you would like? Is it something you would like to do in the future?
If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
We'll see if he does.
If he says, Chris, I want you to do the job, I'll say yes. But he's not talking to me, so that's it.
Here's the latest this morning. Fed Governor Chris Waller in the mix to replace Fed Chair Jay Powell. Skylar Montgomery Koenig of Barclays writing an early start for a more dovish shadow Fed added to the greenback's woes. But in the last couple of weeks, there are signs of consolidation. Skylar joins us now for more. Skylar, good morning.
Good morning. Thanks
what
for
are
having
those
me.
signs of consolidation that you've got your eye on?
Yes, absolutely. So I think what markets were very worried about when you got Liberation Day was you had an unnatural correlation with the dollar and risk. I think the other part of the picture was there was this worry that tariffs would be very negative for the U.S. relative to the rest of the world because the U.S. was picking a fight with everyone. Everyone would fight back. What we've seen instead is that countries have not retaliated, so that's less of a U.S. growth impact. And if you think about what economies will be most under pressure from tariffs, it'll be your small, open, export-oriented economies. And Europe is not small, but it's very open. And so I think now we're having more of a normal correlation where tariffs are seen as more positive for the dollar than maybe previously.
And you see good reason for that to continue?
Yeah, I think so. I think part of it will be a reevaluation of what we're seeing from a growth perspective in the U.S. So I think we had a lot of front-loaded weakness in the dollar in the first half. That looks like it's hard to continue. I will also say there seems to be this asymmetric reaction function that we had in the first half where, dollar bad news was very bad for the dollar, whereas good news was not as good. And so stuff like fiscal, which could be taken as a negative in terms of deficit expansion, Section 899, or a positive in terms of the small growth impulse, was very much shaken on the negative side. But we haven't had some of those negatives feed through, right? The deficit expansion isn't as bad as we thought it would be. Section 899 has been removed. But because we had that weakness, you've had some kind of premium priced in. So there's room for that to come off as problematic policies have come off.
We dealt with trade. Now let's deal with Fed independence, right? It's sort of a whack-a-mole. Which issue are we actually talking about when we talk about the dollar versus the euro? Is the level that we're looking at 116 on the euro-dollar cross, including the potential for a Fed that is disproportionately dovish in response to some of the jawboning from the president?
Yeah, I think there's definitely some kind of a premium priced in terms of a removal of Powell as Fed chair. That's certainly not. I think we saw that clearly in the market reaction function last week, where you saw a strong dollar sell-off when there was a high risk of that. What I would say is, it's clearly unambiguously dollar negative, right? It means that the risk is you have inflation de-anchoring. Buying the dollar, buying U.S. assets is a commitment to buy something that will likely only devalue by 2% per year, which is what the Fed mandate means that you're getting from that. So it is clearly negative. I think the issue is it's hard to actually remove Powell legally, as well as there are 12 Fed governors. So the market's very aware that if Powell's removed even, which seems low likelihood, then you have 12 other or 11 other governors who might not turn that way and likely won't if the data doesn't support it.
Are we close to the threshold of people getting sick of being bearish in the dollar? This idea of the consensus trade, the one consensus trade in the first half of 2025, maybe coming under some pressure.
I think absolutely, and we've seen that in positioning data. So we look at both CFTC, options, and then sentiment, and that had this massive roller coaster this year where it was very bullish, then very bearish, and it's kind of neutralized now. I think part of the story, too, is that there's not a good alternative. It's not like Europe has this great growth story going behind it. If you think about the optimism that was priced in on fiscal, that's largely gone away, especially when you consider that for our 2026 growth forecast, the negatives you get from tariffs for growth are much more negative than the positives you get from fiscal.
So what is it capped as? What's the level it's capped at when it comes to euro dollar?
Yeah, in euro dollar, I think, 120 is the max you can get. Obviously, we're quite a ways from there, but in our outlook, we looked at kind of how you get there. And what I will say is we haven't seen flows broadly move away from the U.S. There's not been this mass exodus from U.S. equities. There's not been a mass exodus from U.S. fixed income. What you have seen is hedge ratios have adjusted. And we've undone quite a lot of that hedge ratio downward trend that you got when the Fed was hiking. And you could certainly have that hedge ratio adjust higher to the detriment of the dollar versus the euro and towards 120. The issue is hedge costs are very correlated with hedge ratios. So if that cost stays high, if the Fed stays where they are, you need continued catalysts and reasons to pay that cost.
Building on Lisa's point, though, about the question of an independent Fed and the president continuously bringing up whether or not he's going to fire Jay Powell or not. What is the long-term damage that could do to the dollar?
Yeah, I think the worry is around the institution, whether or not you get erosion there. And we've definitely seen this not just with threats to the Fed's independence. I think this was also part of the Liberation Day dollar sell-off. I think the hope is that overall, when you're thinking about policies from the U.S. administration, they're thinking about growth-positive policies. And so that would be more positive for the dollar. But certainly it brings up questions that we haven't been thinking about previously. That means that maybe at the margin, you get this de-dollarization, which I think the case is still very out in the long term as to whether or not investors will broadly turn away at the margin from the U.S.
ECB on hold this week?
Yes, I mean, I think that's pretty well expected. I think the question from here is whether you get further easing, and I'd highlight that you're going to see inflation divergence between the U.S. and Europe, certainly. So the U.S. has a price level adjustment at a minimum from tariffs. You also have tighter immigration, and you have the dollar decline in the first half will be an inflationary boost too. On the other side, you have weaker currencies in the Eurozone. Oil prices are much lower. You've got this oversupply from China that needs somewhere to find or some home to find, and you also have a euro that's much stronger, which is disinflationary on top of weighing on exports. So you could see more cuts, certainly.
Green light for them to cut rates if they want to, but no one believes they will this week, at least.
Everyone expects them to remain on hold for quite a while. I'm waiting for someone to ask Christine Lagarde, is this because you want the euro to become the reserve currency of the world, and is this the way that you plan on supporting it going forward?
The global currency. Is that what she's called it, I think?
Yeah, she said, this is our opportunity. Step up, guys.
So the ECB will be a snooze on Thursday, so take Thursday off as well. Scarlett, thank you. It's good to see you. Scarlett Montgomery-Koenig at Barclays. I'm just trying to wrap up the week. See that story about 24/7 trading?
Yeah,
no,
exactly. I know.
Absolutely not.
Yeah.
Bob Michael of JP Morgan Asset Management joins us shortly, alongside Charles Mars of Signum Global Advisors, Eric Mogoloff of KKR, and a whole lot more.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
A cidade estava sitiada.
Nisso eu começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
It is kind of a murky data picture.
We need to be careful of some of these cracks in inflation data.
There are certainly signs that the labor market is more fragile than it looks.
What we're really waiting for is this pass-through of inflationary impact.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and this rally resumes. Equity futures on the S&P 500 up by 0.25%, building up to the gains on the Nasdaq 100 up another 1/3%. Through the week, a sprinkle of economic data and two earnings reports to keep your eye on. This coming Wednesday, Tesla and Google kicking off earnings for the Mag 7.
And this really will be the key week, the second fastest week or the second most active week for earnings reports on the S&P 500. We get a sense of how well the big tech giants are actually doing. Do we get a sense that they're going to exceed expectations as much as they have in recent quarters? And is that enough? We have seen this time and time again. As the bar gets higher and higher and higher, their projections that blow it out of the water still are not good enough. We saw that with some of the banks. Do we see a similar type of reaction from the tech giants?
Tech, AI in its own world. American Airlines later this week. You spoke to United Airlines just last week. They're talking about a second half rebound. A second half rebound. Laurie Calvasino of RBC was discussing this. Investors now focused on 26, looking past all of this headline risk through the summer.
Yeah, although airlines seem to be in a world of their own, and she actually talked about that in some of her notes, how their optimism about the rebound in travelers and consumer spending seems a bit divorced from what we hear from other consumer-facing outlets that show a more tempered or sideways type of market. Does American show the same trend, given that they still also have a big business component to their travel in front of the cabin? We also hear from Southwest. Do we see a deterioration in other more vacation-oriented plane services? And that, I think, will give you a fuller picture of the whole airline sphere.
I mentioned those trade deadlines, August 1st. August 1st, the Southern Post deadline, which can move, of course. The EU is taking that trade deadline very, very seriously, preparing for the worst and preparing potentially this week retaliations.
Preparing retaliations. Also, Jonathan, preparing to potentially just accept an unbalanced trade agreement, because any trade agreement at this moment for Europe might be better than not having one on its own. When it comes to what they could retaliate on, there's two separate lists. One's going after things like soybeans, agricultural in the United States. The second one, more important to the U.S. industrial complex, things like Boeing. And then there's a third they can go into, is this Anti-Coercion Act. That would be the nuclear option. You have individuals in France pushing for that, but others are saying, wait, steady, hold the course, let's get to the finish line when it comes to August 1st.
I thought we had a deal. The EU would accept 10% tariffs, a couple of exemptions on some key industries, and we move on.
You know, Scott Bessent, when he was on with us, said something that I thought was really instructive. He said, either way, President Trump wins. Either we get more revenue from tariffs or potentially we extract a better deal. What is the end point of that type of psychology? When is enough when you have a certain type of concession? That's what I'm curious about.
You enjoying this snoozy Monday morning?
Sort of. I mean, I feel like
July
we're all
21,
you know,
nice and quiet.
The problem is, you know how like a computer, when you click on it too much, it just starts buffering? I feel like I'm still buffering from the rest of the year, so that's kind of where I'm at this morning.
That's your morning. Mine too, you're not alone. Equity futures on the S&P, positive by 0.25%. Coming up this hour, Bob Michael of JP Morgan Asset Management expecting growth to slow. Charles Mars of Signum Global Advisors on the feud between Trump and Powell. Plus, Frank Lee of HSBC on his outlook for the chip sector. We begin this hour with stocks rising. Bob Michael of JP Morgan Asset Management writing the following. The full impact of tariffs has yet to hit. The inevitable reset higher in prices will see some demand destruction from businesses and from households. Bob joins us now for more. Bob, good morning.
Good morning.
Why haven't we seen much of it so far?
Well, I think that's been the amazing resilience of corporate America. Somehow,
They've been able to absorb the first round of tariffs in their margins. It's clear that the tariffs are being charged because revenues to the Treasury are going up. When you look at corporate earnings, they look okay. And when you look at inflation indices, those have been relatively moderate. So where have the tariffs been hitting? It looks like for the second quarter, corporate America absorbed a lot of them. Can they do it in the third quarter? It feels like the administration is solving for a higher tariff level, dare I say, to go from $2.8 trillion to something closer to what the One Big Beautiful Bill Act is, $3.4 trillion, so there's that perfect offset. Probably, I think corporate America has a lot more difficult decisions to make this quarter.
Is that positive for bonds or negative for bonds?
Well, bonds have also been phenomenally resilient. Nothing has gone right for the bond market. Tariffs are higher prices. The One Big Beautiful Bill Act means that there's higher growth, which will support higher inflation. Then you start looking at the rebalancing talk away from America, sell America. That noise still continues. And then you have all the global issuance. Yet here we are, 4 3/8% on the 10-year Treasury, flat to the Fed funds rate. It's not at 5%, probably where it belongs. I think the bond market absorbs it all. I think, like the Fed, it looks through the higher price levels and thinks about the impact to the broader economy and sees the economy slowing down. Not to recession, but we've got somewhere between 0.5% to 1% GDP over the second half of this year.
You've been a big bond bull. You just said that you see 10-year yields somewhere closer to 5% on a real level or based on all of these trends. Why do you think it's not? You talked about the idea that maybe people continue to buy bonds for yield, but does it make you nervous that maybe they're not counting for certain types of strength in the corporate resilience?
Okay, I don't see 10-year yields at 5%. I think they belong at 5%, and that's the great puzzle that they're not there. Once the Fed stopped cutting rates, a natural resting spot for the 10-year should have been some spread to the Fed funds rate. And yet we've hung around 440 for eternity. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market. They've got too much cash, and they're trying to get in. So I don't think I'm going to get the 5%. I would have liked it to have had an opportunity to buy. I think you may get some indigestion. August, September, usually months for consolidation across markets. If we get wider credit spreads, maybe that's an opportunity to add some credit, but I don't think you're going to get the big sell-off in the bond market.
Well, you said that you do expect there to be some ramification from tariffs. One of the ramifications that people have believed there to be is the potential for inflation. If the Fed cuts benchmark rates by 25 basis points next week, Chris Waller would like that to happen, how much do you see the long end selling off?
So I wouldn't advocate a 25 basis point rate cut next week. I'm not, of course, auditioning for the head of the FOMC, so I'm not pushing for rate cuts. I think the Fed is right to just stay on hold, see where tariffs actually settle, then look at the impact to inflation, and then look at the labor market. And I think that's correctly what they're rightly focused on. This time they're going to be right. Inflation will be transitory. What is the greater impact to the labor market? If you start to shoot above 4.5%, then I think they will step in and cut rates to try to stabilize the economy. And then, of course, that puts a lot of chips on betting that inflation will come down early next year.
Bob, what if we never get to the end tariff story? We could be constantly negotiating the rest of this year.
Well, that's almost the ideal situation for the markets, right? You're dealing with a 10% base rate. You're dealing with some higher tariffs across different parts of production. You've got a lot of carve-outs. And when you step back and look at the economy. The market has absorbed that. It's okay. Corporate America can adjust to that. Businesses and households can adjust to that. And the markets are embracing that and saying, okay, that's moderate growth, moderate inflation, not so bad.
Is it fair to call the case to cut interest rates just an audition? Is there nothing credible in the argument for you at all?
The only thing credible for me, the only weakness that I see, and the labor market I think you can put to the side a little bit for now, because there's a lot of anecdotal evidence.
Well, that's the epicenter of the argument coming from Governor Waller. It's the weakness in the labor market that's coming together.
Okay, that can be his argument, but you're in the lows, 4% in unemployment. You haven't seen the real impact. For me, it's the housing market. That's the one thing that tells me that rates are moderately restrictive. You've got a shortage in housing, you've got a lot of demand out there, but housing affordability is at one of the poorest levels in history. There are three components of that. Home prices aren't going to come down. Real wages are going up, but it will take a couple years to catch up to where home prices are. The third is mortgage rates. Mortgage rates just below 7% make the housing market unaffordable. If you bring mortgage rates down, I don't know, it doesn't have to come down 2%, a half, 0.75%, I think you see a pickup in new and existing home sales. To me, that's the key sign that the housing market, the current rate policy is restrictive.
Key question here is just whether or not there is inflationary pressure in the system enough that if the Fed were to cut rates currently, that would lead to a reacceleration. It would lead to something that maybe wasn't transitory. And that's the reason why I asked if the Fed were to cut by 25 basis points or 50 basis points this year or even more, would that cause the belief of a reacceleration of inflation to get baked into the market, making mortgages less affordable, right? I mean, that's the key question.
Yeah.
So what's that tipping point at which rate cuts are counterproductive to what we're seeing at the long end of the yield curve?
Well, if you start lobbing in 50 basis points now because you're saying, hey, we all agree on the FOMC that around 3% is a neutral rate. We're at 4 3/8%. Let's go for it. Let's start throwing in the 25s and 50s and get down there. And yeah, you start to bring rates down like that, I think that will give corporate America a sense of confidence to push through a lot of the tariff pricing to the consumer. Right now, they're weighing how much do they absorb, how much does the consumer absorb, how much do they make the exporters absorb. They'll push more of that through. Then consumers may choose to finance that. They may take out a bigger mortgage. They may go ahead and take out a bigger car loan. We'll have to see. But the real problem is if that becomes embedded in wages. We don't see that yet, right? I talked about low fours are pretty much full employment. John made the point that, hey, it's been rising. That's the center of the storm out there that people are talking about. The Fed should be cutting rates. So if that's true and unemployment has been going up and people are concerned about the stability of the labor market, you're not going to see a price wage spiral. You're not going to see wages shoot up like that.
Bob Michael of JP Morgan Asset Management. Bob, thank you.
Pleasure to be here.
A nice, quiet summer Monday. Next Wednesday, if this week's going to be a snooze, and I think it might be, based on this morning so far, next Wednesday won't be. A week on Wednesday, a Federal Reserve decision, and that one could be interesting.
Expect dissents. I think that's what we heard from Fed Governor Chris Waller, that he is ready to dissent on the consensus position that they're going to hold steady and prepare for a rate cut in September. He'd like to cut as soon as next week. And the why is going to be important. How do they justify how this is not political and this isn't just an audition to be the next Fed chair?
Equity futures on the S&P positive here by 0.2%. With an update on stories worldwide with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Trump is pushing back on a report that Treasury Secretary Scott Bessent warned him against ousting Fed Chair Jay Powell because it would be bad for markets. But in a post on Truth Social, Trump called the Wall Street Journal, quote, typically untruthful, and went on to say he knows better than anyone what's good for markets. Meanwhile, a Delta Airlines jet was forced to abort landing to avoid a mid-air collision with a B-52 bomber. The incident happened last week in North Dakota near an Air Force base. Citing the pilot, ABC News reported the plane had to make an aggressive go-around maneuver as the other aircraft became visible. ABC News says afterward, the pilot apologized to passengers. And sticking with the airlines, Alaska Air has resumed operations after an IT outage temporarily grounded its fleet on Sunday. The grounding lasted about 3 hours. It's the second time in just over a year Alaska Air has had to ground its fleet because of IT problems. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, the feud between Trump and Powell.
The president is an amazingly transparent person. When he thinks something, he says it. So he says, look, this guy's doing the worst job. We have interest rates the same as Gabon. Whether he decides to let Jerome Powell stay in the job or not, I'll leave that to Donald Trump.
Rate differentials are important. I'm not sure about that rate differential, but rate differentials are important. Charles Mars of Signum Global Advisors joins us next, live from New York City this morning. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question. It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Live from New York City, welcome to the program. Just short of all-time highs going into the weekend. Looking for another record high. As we begin a new trading week, equity futures positive by 0.2% on the Nasdaq 100, up by 0.25. Under surveillance this morning, the feud between Trump and Powell.
The president is an amazingly transparent person. When he thinks something, he says it. So he says, look, this guy's doing the worst job. We have interest rates the same as Gabon. Whether he decides to let Jerome Powell stay in the job or not, I'll leave that to Donald Trump. I think the guy's doing the worst job. He's costing us, you and me and the American people. It's just wrong. I don't know why he's torturing America this way. Our rates should be lower.
It's the latest this morning. President Trump disputing a Wall Street Journal report that Treasury Secretary Scott Bessent advised him against firing Fed Chair Jay Powell due to the market reaction. Trump posting on Truth Social, if it weren't for me, the market wouldn't be at record highs right now. It probably would have crashed. People don't explain to me, I explain to them. Bloomberg's Akela Gardner joins us now for more. Akela, welcome back to the show. We caught up with the Treasury Secretary Scott Bessent just last week, and he acknowledged the formal process to replace Chairman Powell had started. Can you help us all understand where we are in that process and how soon we'll find out who will be the next Fed chair?
Well, the conversation about whether President Trump would fire Fed Chair Jerome Powell is far from over, and that is in part because the administration is looking into the Fed's renovation building projects. They say they have a $700 million cost overrun for a project that was initially valued to cost less than $2 billion. It's now surpassed the $2.5 billion mark. But Fed Chair Jerome Powell responded to questions from Budget Director Russell Vought last week and said essentially that they've ordered the independent inspector general to take a look at the cost overruns. They are also blaming inflation potentially on the rising costs, but essentially said there's nothing to see here. There's nothing nefarious happening. But President Trump has floated the idea of potentially fraud being involved here, which would be a criminal offense. No evidence yet of that, but the administration is planning a visit to the Fed's properties to look at these renovations. It's really unclear what will come of that, but there's already a race to replace Jerome Powell, whether it's this year or at the end of his term in May 2026.
Akada Gardner with the latest down in D.C. Akada, thank you. Akada mentioned that visit to visit the Federal Reserve HQ. Senate Banking Chair Tim Scott also in talks to attend as well, according to reporting from Semaphore earlier this morning.
Yeah, to me, it's sort of the political hot potato. Who can you blame? You know, I got sucked down a rabbit hole looking at Gabon and the national parks in Gabon.
Is that how you spent the commercial break?
4.5% interest rate?
100%. They've got 4.5% interest rate. And I have to say that they've got gorillas and dolphins. And I mean, I'm just thinking, like, you know, it just sends me on this rabbit hole of where in the world are they thinking of today?
We've got 60 seconds here to talk about this. The administration has a rather unique way of thinking about interest rates in ways that maybe central bankers don't.
They think of it like credit risk, the Microsoft or Apple's. If you have an incredible credit worthiness, you should pay lower rates. While the rest of the world looks at it as a measure, some sort of approximation of growth and inflation. If that's the case, the interest rate should be higher. In the developing world, it's credit. In the developed world, it's sovereign. Do you really want to flip that on its head?
It's an interesting point of tension that isn't going anywhere anytime soon. Charles Myers of Signum Global Advisors has this to say: our base case has been and remains that US President Donald Trump will not dismiss Fed Chair Jerome Powell, at the very least until after the September FOMC meeting. Charles joins us now for more. So Charles, you've given us the best case, 2 months. What happens after that if they haven't reduced interest rates?
Yeah, if the Fed doesn't cut at the September meeting, I think the president moves forward with a shadow chair nominee announcement and continues to build the case to dismiss Powell for cause, hoping that Powell will resign. I don't think Powell will resign, but I think that case will continue to be built. What the president really wants is for the Fed chair to resign. And, you know, Powell's not going to do that, most likely. And the other part of this process is the president really trying to socialize with the markets this idea of replacing the Fed chair. The only guardrail working in the United States today in terms of a check on executive power is the bond market. And I think that's what they're most worried about. So the September FOMC meeting is critical. And we'll see what the Fed does. Otherwise, we have a shadow Fed chair.
Well, wouldn't it be even harder, though, for the collective body of the FOMC to cut if he was to get rid of the Fed chair, or say he was going to fire him after the September meeting?
Absolutely. I think, you know, everyone in the markets understands that it's a 12-member FOMC vote. It's not just the Fed chair. But the president sees Powell as the obstacle, and he really wants a Fed chair in, whether it's shadow or if Powell resigns. Even if Powell resigns, by the way, the FOMC picks the Fed chair. So I think what the president's really doing is using Powell as the punching bag for higher rates. He's also worried, I think, that even though the administration doesn't believe that tariffs will be inflationary, that if inflation does pick up over the next several months, you can blame the Fed, blame Powell. But ultimately, I think this shadow Fed chair idea, which even 3 or 4 months ago sounded really far out there or deeply concerning for the markets, is now being socialized and probably happens after September.
Well, the Treasury Secretary talked about the fact that there could be confusion with the shadow Fed chair if Jay Powell doesn't step down after his chairmanship is over, but he still has a governor's seat until 2028. Do you have any indication that he would stay the course until 2028?
Absolutely. I think Chair Powell will stay on the board after his chair term ends, and he stays on the board until the end of his term in 2028.
But wouldn't that look very political, Charles? Charles, that would look incredibly political. Most chairs step down.
Absolutely, but I think it would be a really strong statement by Chair Powell, encouraged by some of the other members of the FOMC perhaps, as a statement of very strong independence. And that's why I think he stays on.
Charles, there's a question of what happens if, let's say, Chair Powell is fired. And for cause, gets mired in all sorts of legal disputes. There's this issue of, does Congress confirm whoever President Trump nominates to replace him? How much unity is there right now among Republican Congress members?
Well, I think, whoever is nominated has to be confirmed in the Senate. The Senate, including the Republican caucus and the Republican leadership, do take Fed independence very seriously. So whoever's nominated will be a very respectable and acceptable and very positive person for the markets. It'll be one of the folks that are auditioning very publicly for it. But in the end, I don't think that's going to be the issue. That person will get confirmed. The issue is, will they try to sway the FOMC to be more dovish?
Charles Mars of Cigna Global Advisors. Charles, thank you, sir. Looking forward to the Game of Thrones over the next 12 months or so.
Are you?
None of us have got a direct line into Chairman Powell and what he will or will not do with that seat. But ultimately, if it is a credible candidate, I think most people would assume on Wall Street he'll step aside.
Because ultimately, that is the tradition. That's what they would do. And to Anne-Marie's point, I think it's a valid point. It would be viewed as sort of thumbing his nose at President Trump to not let him have that extra seat, which then starts to become this question of, is he trying to hold rates high in order to have a political move?
As far as I can understand, between conversations with people in the administration, also reading the tea leaves, the issue is he has yet to tell them. He has yet to tell the president, he has yet to tell Scott Bessent whether or not he is going to step aside. And they need to know, because why? They want that seat. Because they know that this is a collaborative body and that they want that seat to make sure they could put individuals with their worldview into the FOMC.
They want a plan. That line in the sand then for Charles at least September 17th. They could be cutting interest rates by then. Based on communication that we've had from this chairman, from this whole FOMC, it looks like they'll be cutting interest rates by then.
It feels a little bit, I just have to say, the whole question of whether he stays on, it feels like if you have a kid who's 6 and they want some toy and they don't really want it and you're like, no, you can't have it, then they really want it and they're going to hold on to it forever and they're going to demand it.
It's got to have leverage.
Well, for what, the toy?
It's got $1 million speeches to give.
Yeah, you're not exactly
Keep that seat.
whipping out the violin.
I wouldn't, but hey, all right. Up next, Eric Margoloff of KKR saying 401ks investing in private equity would be a game changer. That's next.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. In On Site with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Coming off the back of a week of gains on the S&P 500, just short of record highs going into the weekend this morning. Equity futures shaping up as follows. Futures positive by 0.2% on the S&P. On the Nasdaq, up by 0.25%. As we wait for earnings season to kick off for the Mag 7, look out for Wednesday when you'll hear from Alphabet and from Tesla. With 2 hours into the cash open, let's get you some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. We've already got a handful of earnings to work through just this morning. Stellantis off the lows of this morning. Originally, when it started to trade in Europe and the ADRs, that's what you're looking at in the pre-market, it was down sharply, now down just 0.2%. The thinking is perhaps this quarter was a kitchen sink moment. They recorded a $2.7 billion loss. The expectation was a profit. It's a new CEO who has to deal with everything from tariffs to shutting down some expensive EV projects. Meanwhile, at the top of this hour, we heard from Verizon. They narrowed their guidance for EPS growth for this year. Originally, they saw 0 to 3%. Now they see 1 to 3%. That's off the back of thanks to what they say are tax reforms, better performing businesses, and they're also able to increase their costs of their wireless business. So those shares up just under 5%. We also heard from Domino's Pizza. They reported at the top of the last hour, those shares are up 6%. They beat on same-store comparable sales for the second quarter. They also opened up more stores, both in the U.S. and internationally. The CEO saying that they are a value offering. And right now, as there are macro uncertainties, that's what customers want. They also apparently launched a stuffed crust pizza, which I didn't realize they didn't have one. So maybe that helping things in the second quarter too, John.
Corporate America getting it done in many ways. Danny, thank you. Bramo's face then on the prospect of a stuffed crust pizza from Domino's. That was special.
Stop revealing what I do when you're not looking at me.
That was special.
Okay,
on our radar this morning. I'm going to move on. Don't
Does that
worry.
sound good to you?
It's not something I would eat.
Okay, well, let's see your face.
No, I'm not pulling faces, though. President Trump denying a Wall Street Journal report that Treasury Secretary Scott Bessent talked him out of firing Fed Chair Jay Powell. Writing this on Truth Social, people don't explain to me, I explain to them.
Basically saying the Treasury Secretary didn't have to come in and explain to me the impact of what firing Fed Chair Jay Powell would do. Almost admitting that he knows the implications could be negative when it comes to the economy and the market. Still, to this point, the president is going to continuously go after the Fed. First, it was about Jay Powell and cutting of interest rates. Now it's about the renovation projects we've been talking about all morning. They're making a field trip over to the building, some Republicans and probably Ross Vaught, to see exactly what those renovations look like that actually are over budget, but the Fed says are in line basically with what's needed from this building from the 1930s.
Unpopular view. I'm sick of this story. I'm really sick of this story. I
Well,
think
it's gonna be-
I mean, I know, but it just
What
is
makes you think that's an unpopular view?
Well, I just feel
think
like
that's
I just would
overwhelmingly
like to
popular.
just move on. And ultimately, we know that he's trying to find some excuse because he wants interest rates to be lower. President Trump is a real estate developer. What a shocker. There is an unconventional view of why he should lower rates. You can blame inflation then. You can blame potentially any kind of slowdown. You can blame everything on this guy. Okay, this is what we're going to be talking about.
Also an argument out there over the last week that it's just one big distraction from other news dominating Washington
Like what?
at the moment.
Yes, exactly. Well, this is something that people have talked about, the Epstein files and what that actually does.
Also, I cannot get over the polling over the weekend. 70% of Americans say they want this administration to focus on affordability. Well, when you're talking about inflation, there's one prime suspect that you can blame if you're not going to blame this White House. You can blame the Fed chair, and that's what they're doing.
That's the latest stateside. I just want to fold in some news out of China. China reportedly stopped an American citizen who works for the U.S. Commerce Department from leaving the country for several months. The Washington Post reporting the Chinese-American individual had traveled to meet relatives in the country.
And this is something that we saw with the Wells Fargo employee recently as well, and it raises a question about what type of travel bans end up being used as some sort of negotiating chip ahead of a Trump-Xi meetup. The idea that in the United States, if everything is on the table, well, in China, everything could be on the table too, including potentially preventing exits from travelers from the United States, raises questions about international companies and how they do business in the region.
Programming note, if you're about to fly this morning before we move on to our next story, might be flying to China, I've got no idea. Just cover your ears for a second. A Delta Airlines jet forced to abort landing to avoid a mid-air collision with a B-52 bomber in North Dakota on Friday. This is shocking. ABC News reporting the pilot called the go-around maneuver aggressive and then apologized to passengers after landing.
Yeah, it sounds like it was just a nosedive and then a spike upward to try to avoid this military plane, Minot, in North Dakota, which is where this plane was flying to. Kind of separated from anything. That whole region is pretty much separated from anything, home to a huge U.S. Army and Navy base, and it raises a question about how much there is cross-communication. Again, the idea of traffic control, getting it up to speed, and the investment that's necessary, that's something that we're going to be talking about in an ongoing basis.
Incredibly scary and shocking. And there was a video posted on TikTok, and the pilot can be heard saying, basically going through what happened. He said the aircraft was, quote, kind of sort of coming at us. Nobody told us about it. This is scary stuff. Can you imagine being on that plane and this pilot trying to navigate this? And once again, center stage, headline news for Americans is whether or not it's safe to travel.
All I can say, congratulations to the pilots. They did a great job.
Big time.
True. Yeah, I think that's pretty impressive.
Because hard pass from all of us, that's for sure. Let's turn back to markets. President Trump finalizing an executive order that would pave the way for 401k retirement plans to invest in private equity.
We've heard a lot of input from both the investors who want access to the private markets and to those sorts of products, and obviously from the people who are producing the products who are about to meet that demand. So, but we have to do it carefully, I think, because of course the private markets are a lot different than the public markets.
Eric Mogilov of KKR calling the move a potential game changer. I'm pleased to say that Eric joins us now for more. Eric, good morning.
Good morning. Thanks so much for having me.
Why would this be such a big move from your standing?
Look, obviously we'll need to see what happens, and we'll need to see whether we see the executive order, whether we see legislative and regulatory changes happen. But if we do, it could make a meaningful difference to the U.S. retirement market. Look, we have to acknowledge the fact that the U.S. has a real problem in retirement. There are millions of Americans that are relying exclusively on 401k plans. And the good news is they're living longer, but the challenge is they have a limited toolkit to enable them to retire with enough income. Conversely, if you look at other millions of Americans that are covered by defined benefit plans, they've been benefiting from private markets for decades. We at KKR, we manage private assets that benefit over 21 million retirees across public pension plans. And so our view is, why wouldn't you want all Americans to have the ability to have that full toolkit so they can retire with dignity?
If I were being cynical, which of course I'm not, I would speculate that maybe some of the premium has already come up from private equity. The gains have been got, and that's been from some of the big institutions. You started to see private equity returns lag behind some public markets. How do you make the argument that this is actually going to be beneficial to potential retirees rather than just getting in after it's already good and sort of picking up the pieces afterwards?
Sure. So we see the private markets growing substantially. And if you think about it, the public markets, publicly listed companies have been shrinking. A decade ago, there were 7,000 publicly listed companies. Today, that number is less than 4,500. We see really significant opportunities to put capital to work to generate strong risk-adjusted returns. And in fact, we see tens of thousands of financial advisors allocating to the private markets to enhance returns, diversify risk, and gain exposure to parts of the market that they otherwise wouldn't have access to in the public markets.
We've heard a lot about the potential looking outside of the United States, especially as some of the policy headlines that we're talking about just moments ago continue to percolate. How much is that true in private markets as well?
Sure. So as we look across our client base, across institutional investors, insurance companies, family offices, and wealth investors, we are seeing investors diversify across the globe. As it relates to our institutional clients, we are seeing them allocate more to infrastructure, both here in the U.S. as well as abroad. As it relates to insurance companies, as an example, we're seeing them massively increase allocations to private markets, in particular private credit, both here and in Europe. And so we do see investors slowly start to allocate across not just the United States, but outside as well.
What's the most popular when it comes to other areas outside the U.S.?
Sure, it really depends upon the underlying investor and what they're trying to accomplish. So for example, within the institutional space, we are seeing more and more pension plans, sovereign wealth funds, allocate more to infrastructure. And there it's in the developed markets, in particular, US, Europe, a little bit of Asia. As it relates to insurance companies, there we're seeing the focus in asset-based finance as well as private corporate credit. And there it's primarily in the US and Europe.
You keep talking about infrastructure. This speaks to the sort of industrial revolution 2.0 that a lot of people keep talking about. What type of infrastructure? Is this just tied to tech? Is it bridges and roads? Is it the air traffic control stations that we keep talking about?
Sure. Look, the two areas we see the greatest demand from our investors are in digital infrastructure and energy transition. Both of these areas are benefiting from secular changes, which are requiring trillions and trillions of dollars of capital, whether in digital as it relates to AI or in the energy transition as we move from brown to green. We're seeing substantial need for capital, and private investors are filling the void.
Can you just describe the kind of opportunities in that push that you're offering people that I can't get in public markets right now?
Sure. If you were to look at, broadly speaking, in the private markets, there are certain areas of the market that you otherwise are not getting exposure to. So just take, for example, in the public markets. Most investors that are gaining exposure to public markets, they are significantly overweight a small number of companies. Whereas in the private markets, you have a much broader array of both asset classes and in particular sectors of the market that you can capture returns.
Well, let's take one theme, which is what I'm asking about, say AI and the big push to develop energy and everything around it. Can I just get exposure to that in public markets right now with several massive companies, pick out some utility firms doing the same things? What is so special about what you're doing?
Look, what we are finding is more and more companies are choosing to stay private for longer or forever. And so the challenge is you might want to gain exposure to a part of the market that otherwise there aren't public companies available to invest in.
Why is that happening?
Look, there are many reasons why. I think first is many CEOs and company management teams, they recognize the challenge about being public. There is a lot of pressure on quarterly earnings. There is a lot of pressure on the immediate. When we work with companies and when we purchase companies, our focus is trying to find good companies and help them be great and give them the opportunity to build out a robust multi-year strategic plan where they're not encumbered by the idea of having to worry about quarterly earnings every single day.
How hard is that when the technology is changing so quickly and multiples can change so quickly in terms of what the competitive landscape is and what the profit opportunity looks like?
Sure. Look, at the end of the day, what we're focused on is using a value creation toolkit to help good companies become great. And so our view is we worry less about the volatility of multiples, we worry less about the day-to-day, and our focus is on whether it's helping a company expand internationally, whether it's helping a company go into a new market. Our focus is trying to help these companies essentially take their business models and expand and grow.